Very good morning, friends. So I hope you're doing well on a Sunday morning, and I'm also feeling much better. So we are confident to take the journey on Indus 12 forward with you today, and I hope you made a revision of the last two classes which we had covered on Thursday and Friday as far as the basic inputs on the standard is concerned. Now, I guess since there has been a little time gap, I'm just going to spend a few minutes, around 5 minutes, to give you a quick recap in terms of what we've covered, and then we're going to dig deep into the step three. As you would recall that I had developed a concept of a five-step model in terms of Ind AS 12, though of course the standard does not talk of a five-step model, but this is only for the ease of understanding the concept that I had given you a five-step model in terms of application of Ind AS 12. So to remind you, when we said that we're looking in terms of Ind AS 12, I'm looking in terms of five steps. And I said the step number one is to calculate the book value, or you can say the carrying amount of all the assets and liabilities in the balance sheet. Now, since the standard is based on a balance sheet approach, so naturally we're looking at the values of assets and liability which appear in the balance sheet of a company. Now, when you're calculating the book value of the assets and liability, I also made a mention that there is no role in terms of Ind AS 12. The valuation of the asset or liability would depend upon which relevant standard applies to the concerned asset or liability. If you're looking at inventory, then it is Ind AS 2. If you're looking at PPE, then it is Ind AS 16, and so on. So in this particular case, to calculate the book value, you need to basically apply the aspects of the relevant standard. So no role as far as Ind AS 12 is concerned on the concept of the step number one. Second input which I give you in terms of the step number two is to calculate what we call a tax base of the assets and liability itself. Now, when you go to calculate the tax base of the asset and liability, of course, there is a major rule, and we spend a good time understanding how do you calculate a tax base of an asset and liability. To remind you, when we were calculating the tax base of the asset, there was a focus question what we were putting across to us. We said every asset undoubtedly gives an economic benefits. But would these economic benefits be taxable or not? So I gave you need to basically decide that when the economic benefits will arise, will the income tax authorities also come or not? So you need to get the question very clear that when the future economic benefits will arise, will the income tax authorities come? Now, if you say yes, the tax authorities will come, or we said no, the tax authorities will not come. There are three reasons which we said that they are not going to come: because they've already taxed it, or it is exempt from tax, or it has got no tax consequences. The income tax authorities are not going to come at that stage. Now, if your answer is a no, the tax base and the carrying amount is equal, not giving rise to any kind of deferred tax consequences. But if the answer is a yes, the tax base becomes the amount of future deduction itself. So the focus in terms of asset is benefits will come, income tax authorities will come. So if the benefits will come and the tax authorities will come, only then the tax base is the future deduction available under the Income Tax Act against those taxable benefits. Then, as far as liability is concerned, if you recall, I've given you in terms of liability. So we will focus on two kinds of liability. I give you that as far as liability is concerned, you need to very consciously see, is this a liability which is a case where it is going to be settled? Or is it a liability, in which case you are going to provide goods and service? So there might be a liability which you're going to settle in terms of cash. The board opinion is going to be a cash settlement, or you're going to look at liabilities which will be discharged by way of, you can say, providing goods and services. So that would be a situation where you say there is an income received in advance and your obligation gets discharged in the form of providing goods and services to the customer. Now, in this case, again, when we said that the liability will be discharged, we started looking at a focus question. When you're going to get a settlement, when the liability will be settled, will the income tax authorities give you a deduction or not? So when you go to pay the liability, will the income tax authority give you a deduction or not? So the question you go to ask is, when you pay the liability, are you going to get a deduction by the income tax authority? So the answer is again either a yes or the answer is a no. Now, if you say that they're not going to give you a deduction, then the tax base and the carrying amount is same, resulting in no deferred tax implications. But if you say, yes, I am going to get a deduction, remember it is the carrying amount minus the future deduction. You need to be careful that in terms of the assets, the tax base is the future deduction itself. But in terms of liability, it is the carrying amount minus the future deduction. And logics I've already given you that we are calling the carrying amount of the asset as future income. We're calling the tax base as a future deduction against that income. So when you compare the carrying amount, which is like a future income, against a tax base, which is like a future deduction against that income, you're going to get a taxable or you're going to get a deductible differences in that case. But before that, if you're looking at the liabilities which are going to be discharged by way of goods and services, then we can say in this particular case, we decided that the tax base is the carrying amount minus the revenue on which there will be no tax in future. So you need to consider the revenue on which there will be no taxes which are going to be paid in the future. So you need to consider the revenue on which no taxes would arise. The focus is very clear, the amount of revenue on which no taxes would arise in the future. So this is what we did in terms of the step number 2 with you. And then I came to the journey on step 3, and we are discussing the step 3 in detail now. That is, you need to compare the carrying amount in step 1 versus a tax base in step number 3. So whatever you've done in step 1, the carrying amount, and in step 2, there is tax base, you compare the two, and I gave you a complete chart, which I'm just going to shortly revise with you. Then I said in terms of step number 4, you've got the taxable temporary difference or the deductible temporary differences in terms of step number 3. The step number 3 is going to give you the information on a taxable or a deductible differences that needs to be multiplied with a tax rate. And I said the focus in step number 4 is the tax rate, which in any case we mentioned is going to be a substantially enacted rate. Now we're going to see a bit later that what exactly is a substantially enacted tax rate, but you can say something which is not applicable for the current year, but it is applicable for the coming year, the next year, but it needs to be enacted substantially. And then finally, the step number 5 was on recognition. That where do you recognize the deferred tax in the books of accounts? And I gave you the inputs that when you're looking at the recognition, income and expenses in terms of Schedule 3 gets captured either in terms of P&L section, or they get captured in terms of OCI section, or they get captured directly in equity, that is SOKI. So you need to consider what we're going to see in step 5 today itself, that once you recognize the deferred tax, there are basically 3 places where a recognition could take place: the profit and loss section of the income statement, the other comprehensive income section of the income statement, or it could be in terms of equity that is directly taken in statement of changes in equity. So these are the 3 places where the recognition could take place. So this was in short the journey what we have revised on Ind AS 12. I thought before I take it further, let's do a quick recap on things so that the memory is working absolutely sharp. Okay, so we are done with step 1 and 2 already. We are now concentrating on step number 3, which is the most crucial step in the standard. So my main area of discussion today is going to be heavily on step 3. So to caution you, of course, things are going to be technical today. But of course, I promise you, if you hear this very carefully, understand the concept, it's going to be a cakewalk. So the only terms and condition is you need a very careful listening in terms of things. Just understand, appreciate. If there are any questions coming in between, please feel free to ask. So we're going to start the concept in terms of step number 3. Now, I had already given you a chain of thought also in terms of step number 3 in the previous session. And just to remind you, when we're looking in terms of the step number 3, I gave you a chain of thought in terms of step number 3. So let's keep that chain of thought very clear in mind. So I'm just going to give you quickly the chain of thought, and then we'll start working on the step number 3. Let me see in the meantime if there are any questions coming from my friends. Okay. Yes, thanks, Shriram. Thanks. Good morning, Koshki. Good morning, Viraj. Good morning, Ramrita. Good morning, Shriram. So thank you. So I think I'm feeling much better. The throat is much better indeed. So I'm very confident of taking the session today for 3 hours complete. Okay, all the blessings of your people. So I think that, makes the show go on. Okay, now in terms of the chain of thought, I had given you that when you go to compare the carrying amount in step 1 versus the tax base, we decided we are going to get 2 kinds of differences. So one is what we call a taxable temporary difference, and the other is what we call a deductible temporary difference. So we're going to get 2 kinds of differences. One is taxable and one is deductible. Now, we decided that if you're looking in terms of the taxable differences in terms of assets, this will be true when the carrying amount is more than the tax base. And in terms of liability, this is going to be true when the carrying amount is less than the tax base. Reverse for liability. So get this focus very clear that in terms of assets, when the carrying amount is more, you're going to get more income and a less deduction, tax base. So you're going to get a net income. Liability is the other way around. Similarly, in terms of deductible differences for assets, if your carrying amount is less than the tax base, you're going to earn less in the future, but the deduction claim against that income is going to be more. So this will give rise to a net deduction in the future. And liability is going to be the other way around, that when the carrying amount is greater as compared to tax base. So mathematically, when you're going to look at the step number 3, it's not going to be a difficult position at all. Because you need to just know mathematically that yes, you've got a carrying amount on step 1, you've got a tax base on step 2, you compare the two, and you get a taxable or a deductible difference. Now, the important area in terms of things now is that when you calculate a taxable temporary differences, I said you are going to block them in 3 areas. I call the taxable differences divided in 3 blocks. One is the block 1. So one is what I called the block 1, and this is a case of what we call exceptions. And there were a total of 2 exceptions I gave you where a DTL is prohibited to be created. We need to understand these exceptions now in detail, that which are these 2 exceptions where the standard says, yes, there is a taxable difference, but you cannot recognize a DTL in these exceptions. Then there is going to be a block number 2. Then in terms of the block number 2, there is a case of assessment. There is a case of assessment, and there is one case of assessment. wherein we will have to make an assessment that whether a DTL should or should not be created. So we'll have to take a call that DTL may be created or the DTL may not be created. So we're going to look at the assessment case that is in block 2. And you can say in any other case, the block 3, in any other case, which is block 3, you will definitely create a DTL. No ifs and buts. No ifs and buts. So you need to see the question on a taxable difference. C, it should not fall in exceptions. See that is it a case of assessment. If neither exceptions nor assessment, it's a normal question. Then if it is a normal question, you're going to create a DTL and there are no ifs and buts in that case. So the moment you know the exceptions, the moment you know the assessment case, I think by default, you know the any other case in any case. Similarly, in terms of the deductible differences, let me now take you to the journey back. So in terms of the deductible differences also, we divided this in terms of 3 blocks. There is a block number 1, which is a case again on exceptions, where the standard makes it very clear that you cannot create a DTA. So this is the block 1 where the standard prohibits you that you cannot create a DTA. So there is only one exception in this case where a DTA is prohibited to be created. Similarly, in terms of block number 2, there is a case of assessment. Same concept. And this assessment also includes only one case. So we're going to see one case of assessment where you need to decide that a DTA may or the DTA may not be created. You'll have to take an assessment. So a judgment would be required whether a DTA needs to be created or not. And then you can say the third block, or we can say any other case. We can say the third block, or I can say any other case, in which case a DTA would be created, but there is an ifs and buts. Remember, in terms of a DTL, there are no ifs and buts. But in terms of DTA, there is a ifs and buts. And if you recall, the if and but is with reference to what I call the concept of prudence. That we need to prove at the time of creation of a DTA that there is a reasonable certainty that future taxable income would arise. So we're going to look into a COP, that is a concept of prudence, wherein I'm going to give you a 3-step model later. You can get an independent questions, and it is already come in the exams, where the examiner would test you, do you know how to assess the prudence? Can we make an assessment that yes, we are pretty sure, reasonably certain that a future taxable income would arise? So the concept of prudence we will cover later, and this is going to be based on a 3-step model which I'm going to give you of my own. So I'm going to give you another 3-step model in terms of the COP. So I hope, friends, the chain of thought in terms of step 3 is 100% clear. I don't want 99.99. I want 100% clarity on the thoughts. You need to be very clear that if you're going to get a taxable differences, it is either a case of 2 exceptions or it is a case of 1 assessment, and if not, create a DTL. If it is a case of a deductible differences, it is a case of 1 exceptions, it's a case of 1 assessment. Any other case, you can create a DTA, but you need to prove the prudence. So there is no ifs and buts for a DTL, but there is an ifs and buts which is attached to a DTA. I guess I am 100% or more than 100% clear on my chain of thoughts. Okay, I think Viraj, you've got a question. Sir, how to calculate a tax base and carrying amount in consolidated balance sheet of a newly acquired subsidiary on 1st April 23, both balance sheet date and acquisition date, also a DTA and DTL tax expense. No worries. I am carrying a question with me today, wherein this is one of the examination questions, which I'll come to that later once my discussion gets over. So I think I can definitely show you the question in advance. And this is the question. So we're going to cover this up. This is an RTP May 2019 question. And I think if you're looking in terms of the inputs, you can have a look out here. The question is very clearly concentrating on that prepares a consolidated financial statement. So your question will definitely get taken care at the right time. So no worry, no worry. So right now, I'm just keeping your question pending for some time, but don't worry, I'm going to come back to your question very soon. So I just wanted to show you and give you a comfort zone that yes, we are going to cover the things. So no worries on the consolidation part. Okay, that's clear, Koshki, wonderful. Namrata, so please repeat the taxable or deductible differences in terms of liability. Okay, let me put that once again. And I'll just consolidate the chain once again before we take it further. We are looking at a difference is either taxable or deductible in nature. Now you need to remember liabilities will be exactly reverse of the assets. So in terms of assets, when the carrying amount is more, it means a taxable difference. But in terms of liability, logically, it would be the other way around. Now you would start thinking, can we get into a logic in terms of things? I'll do that maybe later because, I have a lot of things to do. So for the temporary purposes, I'm just giving you that you need to apply a reverse logic. If you've understood the concept of a carrying amount in terms of asset is a future income and the tax base for the asset is a future deduction, we need to remember that in terms of liability, this is what you're going to pay and this is what the income tax authority will give you a deduction. Not a deduction actually. Let's give you a small little thing just for clarity. Just let's have a look out here. Let me just have a look out here and I'll just give you the inputs. If you open the brackets, the carrying amount, now what is the tax base? The tax base is the carrying amount minus the future deduction. So if you open the brackets, this will cut down and you're going to get a future deduction. So which means that indirectly you can consider if you open the brackets, you'll get a slight logic of that. I'm just giving you a very basic logic without getting into details. But the easy way to remember is that assets, the carrying amount is more, liabilities opposite. Carrying amount is less for the asset, liabilities greater. That's it. Rest, you can open the brackets and get the inputs, but I don't want to take you on that chain because my thought is more concentrating on the 3 blocks right now, right? I hope that temporary inputs helps, I guess. Okay, you said CA is less future deduction. Yes, that's right. Okay. Now, let me take the journey forward and I am going to discuss exceptions simultaneously. I'm going to discuss the exceptions simultaneously. Now, I know none of you might have done business combinations. That is Ind AS 103. But I'm just going to give you a very basic inputs on Ind AS 103 because the exception which we need to discuss is connected to that standard. And we can't wait once you go to do Ind AS 103. So what I'm going to do, I'm just going to give you a very basic inputs based on your previous knowledge on AS 14 IGAP. So I need to first of all take you to the exception number 1. For this, I'm just coming back. I'm just coming back to the extracts of what is given in the standard. I just want to read this to you. This is the para number 15. And in terms of the para number 15, I'm just looking at a taxable temporary difference. It says taxable temporary differences, a DTL shall be recognized for all taxable differences except to the extent the DTL arises from initial recognition of goodwill. Exception 1. I'm just concentrating on the first exception, initial recognition. Now, when I say initial recognition of goodwill, it is a hint towards Ind AS 103. The goodwill arises when you acquire somebody's business. So when you acquire a control over the business of another company, your purchase consideration is compared to the net assets and that gives rise to what we call goodwill, and that is called initial recognition of goodwill. So let me now first go out of Ind AS 12 and let me take you slightly on Ind AS 103. So let's go back. Let me first of all concentrate in terms of Ind AS 103. I'm out of Ind AS 12. I'm just giving you a background on Ind AS 103. Ind AS 103, the name of the standard is called business combination. The name of the standard is called business combination. Now, what does Ind AS 103 discusses? Let me just give you a very basic intro. Let's say there is a company A Limited, and let's say there is a company B Limited, and A Limited acquires a control. A Limited acquires a control over the business of B Limited. So let's say, for example, A gets a control of the business of B. Immediately what shoots to your mind is, so A is a parent company and B is a subsidiary company, correct? And so A would be required to make a consolidated financial statements as well, correct? So let me tell you, we are going to cover the concept of control. We're going to understand the concept of control when you come to Ind AS 110. Ind AS 110 tells you very clearly that for control, the rule-based accounting doesn't work. At the intermediate level, when you've covered the concept of control, we've always said that control comes in when you acquire more than 50% stake in a company. But in terms of Ind AS 110, it is subjective. You may not have a control even if you've got more than 50% stake in a company. You may have a control even if you've got a 45% stake in the company. It all depends upon the facts of the case. But let's not get into that at this moment. So you can go with your previous knowledge that control arises when A acquired more than 50% voting power in case of B. Now, what is a business is what we will cover in Ind AS 103. So let's not get into what is a business at the moment. Just keep one thing in mind, that if A gets a control over the business of B, there are two terms. A gets a control over the business of B, then we can say A Limited will have to trigger Ind AS 103 and do technically what we call acquisition accounting. So what A Limited will have to do, if this kind of situation arises, he will have to do an acquisition accounting quite similar to what you have done in AS 14. So what A Limited would do as a part of the acquisition accounting, he will put the entry assets of B will be recorded at a fair value, not book value. He's going to record the assets of B at a fair value to incorporate the results of B. He's going to record the liabilities of B also at a fair value, and he's going to record the purchase consideration. This will be a figure which will be computed based on 103. So keeping it very simple, you can say these are the net assets. You can say these are the net assets at a fair value. And this is the purchase consideration. So basically, you all know one thing, that when you consider a balancing figure in this entry, it gives rise to a goodwill or a capital reserve. Absolutely similar to what you've done in AS 14. So what does A Limited do? When A Limited gets a control over the business of B, he is required to trigger the application of acquisition accounting under 103. I'm giving you inputs only to the extent of Ind AS 12, not giving you the larger knowledge of 103. The details will be learned when you come to business combination. So right now we're just focusing on one fact, that when A gets a control over the business of B, he has to trigger the accounting which is called acquisition accounting, and he needs to pass a journal entry, and that is assets at a fair value, liabilities at a fair value, and the purchase consideration is taken, and then the balancing figure in this entry is going to become goodwill. So this balancing figure becomes goodwill, and I am talking of this initial goodwill. I'm talking of this initial goodwill as a exceptions in Ind AS 12. Ind AS 12 is telling me when you get a goodwill, in a business combination, it tells me that if there is a DTL on this goodwill, don't create. I'm not giving you the logic right now. I will give you the logic, but I'm just making a statement that Ind AS 12 tells me that when you're going to apply Ind AS 103 and you're going to get a goodwill as a balancing figure on this goodwill, if there is any DTL, please don't recognize. But it says that if there is a DTA, go ahead. So I've just given you one exception. What is the exception? We'll understand the logic of the exception as well. But the standard says in Ind AS 12 that when as a part of 103 acquisition accounting, you would get goodwill as a balancing figure. Remember, if you get a DTL due to goodwill, don't recognize that. If you get a DTA, recognize that. Now, I'm sure you would like me to explain the logic as well. Why is the standard telling me to consider this amount or not? But before that, a bit caution. I'm just going to focus on this entry further. So a couple of questions might arise in your mind as I'm discussing this further, but don't worry, it'll get all settled up. So I'm now concentrating on the entry of Ind AS 103. And watch this carefully because there are a few clarifications where people generally tend to get confused. So hear me carefully. So on the Ind AS 103, the entry done is assets debited at a fair value, liability is given a credit at a fair value, and the purchase consideration is given a credit, which is the figure of PC computed. And then you get a balancing figure. Now, before I take the balancing figure, let me make a few statements. Number one, I'm focusing on the assets and liabilities, that is net assets other than goodwill. I'm focusing on the net assets that is other than goodwill. These assets and liabilities are recorded at a fair value. Please hear each and every word carefully. The net assets are recorded in the books of accounts at a book value, but they are taken in the entry at a fair value. So which means the carrying amount of these assets, is now equal to the fair value as per the acquisition entry. But the income tax people will give you a deduction equal to the original book value only. So for example, you may consider your inventory as a part of this entry at a fair value. So the book value of the inventory is the fair value because you've incorporated this in the books now at a fair value. So the inventory is recorded at a fair value, but the tax base is going to be the original cost. When you go to sell the inventory, the income tax people will give you a deduction equal to the original cost of the inventory and not equal to the fair value, which means that the carrying amount and the tax base will vary. So if the carrying amount and the tax base will vary, it would mean that this would lead to deferred tax consequences. Am I going to recognize the DTA and a DTL on these net assets other than goodwill? Yes. The exception is goodwill. The exception is not net assets other than goodwill. So if you will get any deferred tax consequences on assets and liability other than goodwill, get this clear. If you're going to get any deferred tax consequences on assets and liability other than goodwill, we are going to record the deferred tax asset or liability. And you know what? This deferred tax asset or liability is going to be recorded as a part of this entry. So what we're going to do, we're going to recognize the DTL in this entry. We're going to recognize a DTA in this entry itself. Is that going to change the balancing figure goodwill? Let me ask you, if you are going to recognize the deferred tax asset or liability arising on account of this, do you think it is going to impact this DTA and DTL? Do you think it is going to have any impact on the balancing figure, which is the goodwill? What's your thought? Because I will be recording this DTA and DTL before I take the balancing figure. So before you take the balancing figure goodwill, you will say, okay, let me first of all incorporate the DTA and DTL due to these assets and liability other than goodwill. So is there going to be an impact in terms of the goodwill? Yes. So you can say this will change the amount of goodwill because of DTA and DTL getting recognized. You know, knowingly, unknowingly, if you heard me, now, in terms of the step number 5 of my Ind AS 12, what were the places where a deferred tax is getting recognized? P&L, OCI, equity. Now, I think I've added a fourth place. It is goodwill in a business combination. I hope you're getting the point. So I said in step number 5 that there are 3 places where a deferred tax gets recognized, either in the P&L section, or in the OCI section, or in the equity. Now we added a 4th section as well, that if there is a deferred tax asset or liability arising in a business combination on net assets other than goodwill, then this is getting impacted through goodwill. So you're not putting that in the P&L, you're indirectly putting the entry what? You're putting the entry goodwill debit DTL credit. So the DTL is not getting recognized through P&L, through OCI equity, but it is through goodwill. I hope I made my points very clear. I know you must be thinking, sir, can you put that once again? Yes, I'm just going to consolidate these thoughts once again to you. Keep the focus very clear. When you pass the acquisition accounting entry under Ind AS 103, focus 1. You are going to record the assets and liabilities at a fair value. So when you're going to record the net assets other than goodwill at a fair value, so what is the impact of this? The assets and liability recorded at a fair value means now the carrying amount or the book value is equal to the fair value. But the income tax authorities will not give you a future deductions in terms of assets or future deductions in terms of liability equal to the fair value. So what is going to happen, that the tax base for the asset is the original book value, or for a liability, it is the book value minus the original book value only, because you will get a deduction equal to the book value. So the tax base and the carrying amount will differ, resulting in a DTA or a DTL, whatever the case might be. So you will get a deferred tax, either a deferred tax liability, or you're going to get a deferred tax asset, whatever the case might be. So am I going to incorporate this deferred tax as a part of my entry? Yes. The exception is not related to other than goodwill. The exception is the initial recognition of goodwill. So the first focus, I made it very clear that if there is any deferred tax consequences related to other than goodwill, please put this in this entry itself and then take a goodwill as a balancing figure. So when you're going to record the DTA and DTL in this particular entry, the goodwill automatically changes, which also gives us a clarity of thought that indirectly this DTA and DTL is getting recognized through goodwill. That's focus 1. Now let's go to the focus number 2. Now let's go to the focus number 2. So let's, I think, get on to another fresh entry, not to disturb this one. So let's now get on to the entry once again. Focus number 2. So we did the entry, assets are given a debit at a fair value. Liabilities are given a credit again at a fair value. So you've taken the net assets other than goodwill, and the purchase consideration is taken computed figure on the credit side. Now, focus number 2, friends. Forget about the net assets other than goodwill now. The focus now is on the goodwill, which became a balancing figure. you took the goodwill as a balancing figure in this entry. Now my focus number two is on this initial goodwill. My focus number two is on the initial goodwill. Now, there are two situations. Number one, the carrying amount of the goodwill is greater as compared to tax base, or the carrying amount of the goodwill is less than the tax base. Now, let's take some figures to understand the concept. So let's say that the net assets is to the extent of, let's say, 120 crores, and the purchase consideration is, let's say, 150 crores. So you got a balancing figure that is 30 crores of goodwill. I'm just taking some arbitrary figures just to understand the concept. So you to compare the net assets at a fair value vis-a-vis the PC, and I got a balancing figure. So we get a carrying amount of the goodwill that is 30 crores in this entry. Let's consider, for any reasons for that matter, the deduction available under the Income Tax Act is, let's say, 20 crores. So naturally, the carrying amount is more than the tax base, and due to which you will get a taxable temporary differences, and this would lead to a DTL as per step 3. And the standard says, sorry, you can't recognize this DTL. The standard says that if the carrying amount of the goodwill is more than the tax base of the asset, you're going to get a taxable differences resulting in a DTL. The standard says don't recognize. Now I say, why? Why are you stopping me from recognizing this DTL? I'll tell you. Watch this. If you're going to record this DTL, you're going to put this in this entry, that is DTL will be given a credit. Let's take the figure. The taxable differences is 10 crores. Let's consider a tax at 40%. So you're going to get a DTL 4 crores. Let's take a figure. So you get a taxable difference of 10 crores and a 40% tax rate. So you get a DTL of 4 crores. I said, I'm going to record this 4 crores out here. Now, the moment you land up recording this 4 crores, the goodwill is going to change and this will become 34 crores. Simple maths. The moment you're going to record this 4 crores in this entry, the balancing figure will increase. Because initially, when you applied the concept of carrying amount and tax base, you got a difference. You said it leads to a 4 crores of DTL. I said, okay, let me put this in the entry now. But putting this in the entry immediately increases the goodwill. And if the goodwill increases, you need to refresh your calculations. You need to refresh your calculations, or you need to basically recognize the incremental DTL on the incremental difference. I hope you're getting the point. Because this will become 14 crores, basically increase of 4 crores. So 40% on that 4 crores, you get an additional 1.6 crores of DTL. By recording this DTL, the goodwill changes. By recording this DTL, the goodwill changes. So there is a need to recognize the incremental DTL on the incremental goodwill. Mind the words carefully. You need to consider an incremental DTL on the incremental goodwill. So if you're going to land up taking another 1.6 crores in this entry, so I'm sure you know that this figure changes by another 1.6, it becomes 35.6 crores. I'm going to go mad if I start doing this. I'm going to get stuck up in a circular effect of things. So I'm going to first of all get the DTL, the goodwill will change. I take an incremental DTL, I'll get an incremental goodwill, then again incremental DTL, then again incremental goodwill, the chain will go on. So sir, you mean to say that there has been an administrative issue due to which these standard setters have realized that we should not go in for a recognition of a DTL arising due to goodwill? Yes. The problem is not in terms of the fact that it is a taxable difference. The problem is in terms of the administrative issue which is attached in terms of recognizing this DTL. So the standard takes the convenience route and tells you, why should we tell the industry to get into all this? That you recognize a DTL and it changes the goodwill, and then again you need a incremental DTL on the increased goodwill, and the chain goes on. So they gave the concept, the International Accounting Standard Board gave a concept that it leads to a circular effect. It leads to what we call a circular effect. And due to the circular effect, you cannot recognize a DTL in case of business combination when you get a goodwill. I hope, friends, I am clear so far. Okay, I think we got some questions. Namrati said, in business combination, tax base will be calculated as same as we learned earlier. Yes, of course. You said, okay, we means recognize DTL on the initial goodwill, and then goodwill will increase the cycle and it will continue. Yes, of course. So let me get the points very clear now. Let me get 2 points very clear, the 2 focus points. So which means that when I am applying Ind AS 103, hear this carefully, when I'm applying Ind AS 103, is there a role of Ind AS 12? Yes. Ind AS 12 has got a role, in terms of various standards. There are a couple of illustrations which are given, but it's too early to do them with you unless you've done the other standards like leases, etc. So I'm not going to get into all that. But you can practice those questions once you get the knowledge of those standards, because without the knowledge of those standards, you can't really appreciate the interaction of Ind AS 12 with the other standards. But 103, of course, we need to give you a brief understanding because that's a core exception. So when a company is applying Ind AS 103, I'll say focus 1. If there is a DTA or there is a DTL on net assets other than goodwill, I'm saying if there is a DTA or a DTL on the net assets other than goodwill, recognize them as a part of the takeover entry, acquisition accounting, and that changes goodwill. Focus number 2. The focus number 2 is that if you are getting a goodwill and there is a DTL on account of goodwill, it says don't recognize a DTL because it leads to what we technically call a circular effect. Because every time we recognize a DTL, the goodwill changes and we have to go for incremental DTL, incremental goodwill, and the circle continues. Now let's have a look at the other way around. Let's have a look at the other way around in terms of the carrying amount. Let's say now the carrying amount is 30 crores, and let's consider the tax base in this particular case is, let's say, to the extent of 40 crores. So what are the reasons? Let's not get to the reasons, but what are the reasons the tax authorities are willing to give you a more deduction? So if they're willing to give you a more deduction in this particular case, what happens? You will get a deductible temporary differences to the extent of 10 crores. And considering a 40% tax, you will get a DTA to the extent of 4 crores. Interestingly, the standard doesn't prohibit you from recognizing a DTA. Interestingly, the standard says, please go ahead and recognize a DTA. They stop you from recognizing a DTL on a goodwill. But they don't stop you in terms of recognizing a DTA on a goodwill. Now let's see why. Let's imagine in this entry, if you land up recording this DTA to the extent of 4 crores, what is the impact on the entry? Now hear me very carefully. You get this in a minute, or you don't get this. If you hear me, you get this in a second. Many people think it a little wrongly. When you're going to record this DTA in this entry, you'll say the goodwill will change. I'll say no. The goodwill is not changing. When the credit side is more than the debit side, it is goodwill. But when the debit side is more than the credit side, it's a capital reserve, right? You know the basics from the amalgamation concept itself, that when your debit side is more than the credit side, it is a capital reserve. When the credit side is more than the debit side, it gives rise to goodwill. So which means by recording this DTA, you are going to basically increase the capital reserve. Is capital reserve an asset? Is it a liability? Or is it an item of equity? It's an item of equity. What do you calculate a tax base? You calculate a tax base for asset liability. Do you calculate a tax base for equity? No. Did you get the point? So recording a DTA would increase the capital reserve in the entry, which of course can be set up with goodwill later. But this capital reserve is not an asset or liability, but it's an item of equity. And equity is never, we don't calculate a tax base for an item of equity. The concept of Ind AS 12 is based on recognizing a deferred tax on an asset and liability, not on an item of equity. So even if you land up recording a capital reserve, there will be no implications of deferred tax on the capital reserve, resulting in incremental, DTA or incremental capital reserve. The problem with DTL is that it hits the goodwill. And since goodwill is an asset, you need to calculate a tax base. But the moment you get a capital reserve, it's an item of equity and it doesn't change the asset value or the liability value, which means there is no circular effect issue. So the standard setters, made a very good understanding of the concept, and they realized that when you recognize a DTL in terms of a business combination, goodwill, it creates a problem. But when you recognize a DTA in terms of goodwill, it doesn't create a problem. So the prohibition is only with reference to one area, goodwill, and that also if it results in DTA. So I would put it in a nutshell like this to avoid any confusions in life. I can put it like this in a nutshell to avoid any confusion, that when a company applies Ind AS 103, so I'll put it like this, that if the company applies Ind AS 103, so when a company applies Ind AS 103, I would put it like this. You're looking at net assets other than goodwill. You're looking at net assets other than goodwill. So if you get a DTL or if you get a DTA with reference to these items, do you recognize them? Yes. How do you recognize them? This is recognized as a part of the acquisition entry itself. So when you're going to go to Ind AS 103 business combinations, you have to keep one thing very clear in mind. Any assets and liability other than goodwill resulting in a deferred tax asset liability is a part of the acquisition entry. If you're looking at a goodwill and it results in a DTL, it is prohibited. It is prohibited, and the reason for this prohibition is the circular effect. The reason for this is the circular effect. The standard says it's going to create a problem. But when this goodwill results in a DTA, the standard says, yes, you can recognize the same. Because in this particular case, there is no prohibition. Because it doesn't lead to a circular effect in this particular case. So we need to remember that this is the only exception. We can say this is the only exception in terms of business combination. So the only exception in terms of business combination is initial goodwill resulting in a DTL. I hope, friends, I am clear with my exception number 1. So this is Ind AS 103 and the impact of Ind AS 12. This is the nutshell what you need to keep in mind. This is going to help you even when you come to the business combination standard. You need to be very clear on the thoughts that if there is a deferred tax on a net assets other than goodwill, go ahead. If there is a deferred tax liability on an initial goodwill, no. If there is a deferred tax asset on an initial goodwill, yes. Right? Yes, I am very clear so far. Let me see if there are any questions coming in. Yes. Sharon, you said, sir, DTL 4 crores understood. How 1.6 crores is recognized as an additional DTL? Okay. Well, if you take this 4 crores out here, then the goodwill becomes 34 instead of 30. Because you're recording this DTL. Let's assume that you've taken this 4 crores DTL. Let's say the standard doesn't prohibit me, but for understanding, I took this 4 crores. So it immediately changes the goodwill by another 4. So there is another incremental difference of 4. Because now you'll compare 34 versus 20. So you will get a taxable difference of 14 crores, another 4 crores. The DTL becomes the incremental difference. And on 4 crores, a 40% comes to 1.6 because the difference of 4 into the tax rate, that's going to give me 1.6. So you're going to record this 1.6. The goodwill will further increase by 1.6. Now, what's going to be the next figure? 1.6 into 40%, that's going to come to 0.64, right? That's how the chain goes. And another, they said initial goodwill is allowed as a deduction in tax. Well, as I said, they are the provisions of the Income Tax Act. I didn't get into the logics that why would the income tax give you a lesser deduction, or why would the income tax give you a more deduction? That's something which is based on the provisions of the taxation law. But I'm just giving you the accounting aspect that let's assume that the tax base is lesser, or let's assume that the tax base is greater. Due to any reasons whatsoever, they give you a lesser or more deduction, resulting in a deferred tax asset liability. So if it is a DTL, no. If it is a DTA, yes. Right, understood, Sharon. Great, wonderful. That's right, Namrata. Okay. So far, so good. I guess we've understood the very first exception. So I'm done with the block 1, DTL 1 exception only. I'm done with the block 1, only one exception, because DTA in block 1 doesn't contain this exception. Now I'm going to the second exception, block 1 DTL, and I'm also going to the DTA block 1 exception. So I'm going to now consider the second exception for DTL and a DTA. Second exception is applicable. Second exception is applicable to both a DTA as well as a DTL. Let's watch this out. Let me just watch this out and give you some more inputs in this connection. So let me just, I think, first take you to the standard inputs out here. And let's have a look at the second exception with you. Okay, so now in this particular case, let me just, I think, take it further. And let's have a look at the para number 15 once again. Very carefully, we will look at the second exception. This is tricky language, but I'll take an example to illustrate that exceptions to you. It says initial recognition. It says initial recognition of an asset or liability in a transaction which is not a part of business combination, and at the time of the transaction, it affects neither the accounting profit nor the taxable profit. So in this particular case, we are looking at the second exception, which is a bit tricky language altogether. It says that it's not a part of the business combination. So it says initial recognition of an asset or liability, which is not a business combination, and at the time of the transaction, it neither affects the accounting profit nor the taxable profit. I think let's take an example. So the same language is given in terms of the exception for a DTA as well. Let me just take you there. So that we get a very good understanding that the language is absolutely common. This is the inputs given for a deductible difference. This is the input given for a deductible table differences. It says a deferred tax asset shall be recognized for all deductible differences to the extent it is probable that taxable profits will be available, the COP, unless the deferred tax arises from initial recognition of an asset or liability in a transaction which is not a business combination and at the time of transaction, it affects neither the accounting profit nor the taxable income. The same language is given in taxable differences. The same language is given in terms of deductible differences, exactly same language. So let's take an example to understand this bit. So I'm now going to take you to the exception number 2. I'm now going to take you to the exception number 2. So let's focus on the exception number 2. And let me pinpoint, this exception is applicable. This exception is applicable to both DTL and a DTA. This exception is applicable to both a DTL and a DTA. Goodwill exception was applicable to DTL, not DTA. This exception is applicable to DTL and a DTA both. Don't worry, we're going to make a summary once we're done with this exception. Let's now take this further. I'm taking an example, so watch my example very carefully. Watch my example very carefully on what I'm going to give you. Let's say my company purchased an imported car. Let's say my company purchased an imported car, let's say to the extent of 45 lakhs. So I made a purchase of an imported car of 45 lakhs. Now, what does the income tax authorities tell me? The income tax authorities tell me that we are going to give you no depreciation claims on this car. Even if you get a capital loss or a capital gain, we're going to simply ignore any kind of tax. The income tax authorities very clearly tell me that for us, this car is practically not even existent. They're saying you're not going to get a depreciation claim on this car, and we will not consider any capital gain, capital loss consequences on the sale of the car. It will be ignored. Now let's do one thing. Let's understand that number one, what is the carrying amount? And number two, what is the tax base? Now what's this case? I can say at the time of initial recognition, I would say at the time of initial recognition, what is the carrying amount? It is 45 lakhs. I'm saying the words are very careful. I'm saying at the time of initial recognition, the value, the book value of the car is 45 lakhs. Now let's consider the tax base. What is the tax base? I'm going to put across a question. When this car will be used in the business, are you going to get economic benefits? Yes. You know what happens? People immediately jump to the conclusion, oh, इनकम टैक्स वाले मुझे डेप्रिसिएशन नहीं देंगे और भाई साहब फ्यूचर डिडक्शन जीरो होगी. Don't go like that. Don't go like that. You need to go with the chain of thought. When the economic benefits will arise from the car, will the income tax authorities come? You see, you are going to use this car in the business, so it will help you to sell, provide services to the customers. So economic benefits arising from the use of the car is going to be taxable. Will I be able to tell the income tax people that give me a deduction equal to the depreciation of the car? They say we're not going to give you a deduction. The economic benefits are taxable. The economic benefits arising out of the use of the car is taxable, but the future deduction is zero. So this means we are going to get a temporary difference, and since the carrying amount is more, you will get a taxable temporary differences, and this will lead to DTL. Let's say if it is 40% tax, you will get 18 lakhs of DTL. The standard says that you are prohibited. The standard says that you are prohibited in terms of recognizing this DTL. Now the question rises, why? The question rises, why are they prohibiting me in terms of recognizing this difference? I would like to take you back to the income statement approach in terms of understanding the logic. Now watch this carefully. In the previous session, I have given you a parity of thought that whenever you're stuck up in terms of things, just apply an income statement approach to get a larger picture. Now, I'm just taking for convenience 3 situations using an income statement approach. Situation 1, situation 2, and a situation number 3. So I'm going to take 3 situations to give you a conceptual clarity. I am working on an income statement approach just for understanding. This is accounts and this is tax. This is accounts and this is tax. This is accounts and this is tax. If you remember, last time I gave you an input that if there is an income or there is an expense, if there is an income or there is an expense which is taken in accounts and it is taken in the taxation books in the same year, if there is an income or there is an expense which is taken in accounts and tax in the same year, would it result in a difference? No. If you're recording the item in both the set of books in the same year itself, this means what? That there is going to be no difference. So can I say in this particular case, there will be no differences arising? And that means in this particular case, no deferred tax consequence would arise. And if you remember, I said in this particular case, you will see that when you apply a balance sheet approach, the carrying amount and the tax base is going to be definitely equal. I said that if you're taking an item of income and expense in the books, for example, there is a credit sale, you create a debtors from the accounting point of view, you also create a debtors from the tax point of view. The value of the debtors in both the set of books is same. So if you're recording a particular income or expense in both the books in the same year, this indirectly implies that in a balance sheet approach, the carrying amount and tax base will be equal. I proved this point in the previous class as well. Now let's imagine that you've taken the income and expense in accounts, but not in tax this year, but you're going to take it later, or vice versa. You don't take it in accounts, but you take it in tax, and you're going to take it in accounts later, but you're going to take it. It's a difference which is arising. So you are going to take the income expenses in different years. So you're recording an income and expense in accounting in one year, but you're going to record this in taxation in another year, not in the same year. So if there is going to be a difference, so in this case, if it is taken in a different year, we can say we are going to get a difference. And if you're going to get a difference, the deferred tax will definitely arise. The deferred tax in this case will definitely arise. And if you recall my discussion, I said in this case, if you apply a balance sheet approach, you will definitely get the tax base and the carrying amount is not going to be equal. So this is a parity in terms of income statement and a balance sheet approach. That if things are recorded in the same books in the same year, both the books in the same year, it leads to no difference. The carrying amount and tax base will be equal. If you're going to record the income and expense in different years, then as per the balance sheet approach, also the carrying amount and tax base is going to be different. Now, imagine a situation 3. You take it in accounts and it's not taken in tax, and it will never be taken in tax, and will never be taken in tax. You claim a deduction in accounts and you will never get a deduction in tax. So in this case, what happens? There will be a difference which arises. There is a difference which arises, and this difference arises but is never going to reverse. I'm pretty sure you can give me a nickname. A difference arises but is never going to reverse. Would you like to give me a nickname for this kind of a difference? This is a difference arising and reversing. Arising and reversing. It's a temporary difference. Sorry, this is no difference. So the first case is that there is no difference. The second case is a temporary difference. Would you like to define what is the third kind of difference? I'm sure you can define that the third kind of difference is what we can say. Yes, it's called a permanent difference. That's right. Okay, that's right, Koshki. Wonderful indeed. That's right, Namrata. Wonderful indeed. So it becomes something what we call, it is supposed to be a permanent difference. So this is called a PD. It's called a permanent difference. If you look at the IGAP Accounting Standard 22, it very clearly uses the word permanent difference. But if you look at Ind AS 12, they don't use the word permanent difference. They call it as a case of exception. So basically, the second exception is what? In simple word, the second exception is with regard to a permanent difference. Now, let's, I think, go back to the example and let's have a look now. If you apparently look at this car example and try to understand what is happening, you are going to claim a depreciation for the car in the accounting books, applying an income statement approach, but the income tax books will never give you a depreciation. So there will be a difference which will keep arising year by year, and the differences will never get reversed. So on a logical front, when you know that this car is going to be claimed as a depreciation in accounting, but there is no implications of taxation. That means I will never be able to book an expense in taxation books. So the difference arises, but never reverses. But what will happen that when you apply a balance sheet approach, you are going to get a temporary difference. You're going to get a temporary difference in this case. But this temporary difference is technically a permanent difference. Since this temporary differences is technically a permanent differences, we can say therefore the standard prohibits you from recognizing a deferred tax. Right? I hope I'm clear with the second exception as well, that there could be situations like this. And when you visualize situations like this, you need to understand that if you're going to take an income and expense in accounting, but you're not going to take an income and expense in tax ever, not now, not ever, then in that particular case, it would need a permanent difference. So anytime you are stuck up, in terms of the thought, just look at the fact. If you've taken the income and expense same year, no difference. Different years, temporary difference. Taken in 1 year, never will be taken. It's a permanent difference. So when a company recognizes any asset or any liability, and I know this is a standalone acquisition. That's another input. It's a standalone acquisition of asset liability. We're not talking about business combination. The second exception is very clearly saying that the asset or liability initially recognized is not a part of the business combination, and it neither affects the accounting nor the taxable profit at the initial recognition. So initially, when you are recognizing this car in the books of accounts, it has got no impacts. It has got no impacts in terms of the accounting profit and the taxable profit. So we know that in this case, we are going to get a temporary difference, but this temporary difference is technically as good as a permanent difference. Therefore, it becomes illogical to recognize a difference which will get arisen, but is never going to get reversed in the future. Right? I hope my second exception on the asset example is clear. I'm going to now take you to a liability example as well. I'm going to take another example with you. Just I took it the way for asset. Let's give you another example for a liability as well to get a little more clear understanding of the picture. So let's consider another example, this time from a liability front, because the exception applies to an asset, the exception applies to a liability. So we've taken an exception on the asset part. Let's take the exception on the liability part as well. Let's say the government gives me a tax-free government grant. Let's say the government gives me a tax-free government grant. I'm looking at this income-related grant. I'm considering that this government grant is, let's say, income-related, not asset-related. So the government gave me a grant, which is, let's say, an income-related grant, which is given to the government. Now let's take an example. Let's say the government grant which is given to me is to the extent of 20 lakhs. So what is the entry you pass in the accounting books? Bank account debit. This will be by virtue of Ind AS 20, and you will give a credit to deferred income. This is the entry which you are going to record as per Ind AS 20. So this is the accounting which a company would apply as per Ind AS 20 when you receive a government grant and that is given a credit to the deferred income account. And what do you do with this deferred income? Slowly and steadily, it will be taken to the income statement based upon whatever is the reason the grant is given. So this deferred income, you can say, is going to be spread over. This is going to be spread over profit and loss over X or N number of years. So it's going to be spread over, you can say, N number of years. So it's going to be spread over N number of years. Now, let me ask you something based on an income statement approach. So you can decide logically and then we apply the balance sheet approach. Now, my question is pretty simple. Apply your thoughts. This is accounting books and this is taxation books. This is year 1, year 2, year 3, year 4, year 5. First year, nothing taken in accounts and tax. Let's say this is the year of receipt of the grant. So no income was taken in accounts and it is as it is tax free. Then the income is taken in accounting in the next 4 years to come. And taxation, it is tax free. It's never going to be taken. Is it as good as a permanent difference? Is it as good as a permanent difference? You're recording the income in accounting, but it's never going to get recorded in taxation. So isn't that technically a permanent difference? Yes, it is undoubtedly a permanent difference. But now, if I apply a balance sheet approach, what is the carrying amount at the time of initial recognition? Let's apply a balance sheet approach. I know with my understanding it's a permanent difference. So technically, recognizing any deferred tax asset liability will be illogical because differences which will arise and would never reverse, there is no logic in terms of recognizing them. So we say, okay, what is the carrying amount at initial recognition? It is 20 lakhs. I said, okay, what is the tax base? Caution, friends, now caution. Generally, when you calculate a tax base for a liability, people forget the focus that this is a liability which is going to be paid in cash, or is this a liability which is an income received in advance? You know this. Because many people, while calculating the tax base of a government grant, start applying the definition that will I get a deduction? This is not a liability which is going to be paid in cash. This is like income received in advance from the government. The government gives you a grant in order to meet certain expenses in the future. So it is supposed to be, you can say, income received in advance with the obligation to meet certain expenses in the future. So I'll apply the definition and I'll say the tax base is supposed to be the carrying amount minus the revenue. Minus the revenue on which there will be no tax in the future. So what is the revenue on which there will be no tax? The entire 20 lakh is tax free. So the tax base becomes nil. So I am going to get a deductible temporary differences because the carrying amount of the liability is greater. It's a liability, not an asset. The carrying amount of the liability is greater. So we get a 20 lakhs of DTA. And that would mean that if I take a tax rate, let's say 40%, so you would land up recording 8 lakhs of DTA, but technically this temporary difference is again supposed to be technically a permanent difference. Since it is a permanent difference, it doesn't make sense. So what needs to be done is sometimes in a balance sheet approach, you would calculate a carrying amount and tax base, and you will apparently get a temporary difference. But you need to see that is that a temporary difference? Or is it in substance a permanent difference? So if you're stuck up in terms of deciding that is it a temporary or is it a permanent difference, go back to your income statement approach understanding. Look at the implications of the transaction from the point of view that is it taken in accounts and tax in the same year? No difference. Taken in different years? Temporary difference for sure. And if it is going to be taken in one books but not in the other, permanent difference for sure. So you'll be able to get the conclusion that the difference which is apparently a temporary difference is in substance a permanent difference. And it is illogical because a difference which will arise and not reverse, it doesn't make any sense to recognize those differences. So the second exception indirectly is based on the concept of what we call a permanent difference, applicable to DTL, applicable to a DDA. Okay, I hope I am pretty clear, friends, so far. Yes, clear. Wow, great. Don't worry, we'll make a summary on this very soon. Because if you're able to get the exceptions very clear in your mind, trust me, the standard is already in your hand. Okay, let's, I think, take a quick revision on this input so far, what we've discussed, before we go to the next area. My block 1 exception is done. I'm just going to make a quick mind map at this stage before I go to the block 2. So I just want to make a quick mind map at this stage so that we stand at a common thoughts. So I'm making a little mind map to the extent I have done my discussions with you on step number 3. Let's consolidate the picture before we take it further. And please do revise this class very sincerely today itself. Now, in terms of the step number 3, we decided that you are going to get a taxable temporary differences, or you're going to get a deductible temporary differences. So you will get a taxable or a deductible temporary differences, and I divided this entire discussions in terms of 3 blocks. I divided my entire discussions on this on 3 blocks. I said in terms of block number 1, I said in terms of block number 2, and I'm yet to discuss the block 2. Then I said any other case. Now, in terms of the block number 1, I gave you that there are 2 exceptions. I gave you that there are 2 exceptions. Let's have a look at those 2 exceptions now very carefully. Let's have a look at the 2 exceptions very carefully. Number 1, I would say the first exception relates to Ind AS 103. When due to goodwill, DTL arises. This is one thing I need to keep in mind. That when a company applies Ind AS 103 and you're going to get a goodwill resulting in a DTL, don't recognize, you know the reason as well. The reason is that this is going to be a circular effect. The second exception which I gave you in this particular case is that it is a permanent difference. The second exception, we said that what looks like a temporary difference is in substance a permanent difference. So we can say the temporary difference in substance. The temporary difference in substance is a permanent difference. This is the second exception. So you need to see 103 and you need to see what looks like a taxable difference is technically permanent. Apply the income statement approach at the back of the mind and visualize that whether it is a permanent difference or is it supposed to be a temporary difference. Similarly, in terms of the deductible differences, we decided on the block 1 and the block 2. We have to discuss the block 2, and then we said any other case when we need to understand the prudence, which we do. Now, in terms of the block number 1, we said there is only one exception. We said in this particular case, there is only one exception. The Ind AS 103 exception is not there. Just to pinpoint very clearly, the Ind AS 103 exception is not there. Keep that in mind. That if you're going to get a goodwill resulting in a DTA, that exception is not applicable. So what you have out here is not applicable out here, because recognizing a DTA would lead to increase in equity, which is not an asset and liability. Here there is a circular effect issue, and here there is no circular effect issue. It's a case of a capital reserve. That's it. And so we've got only one exception, that is a permanent difference, which we can say that there is a temporary difference, which is in substance is permanent difference. So you apply your income statement approach to identify that the temporary differences, which looks apparently a temporary differences, is technically a permanent difference. So this is the two exceptions done, and this is one exception done. Let me get you comfort zone, friends. On a scale of 10, on the understanding of the block 1 DDL and on the block 1 DDA, are we now absolutely clear that in terms of the exceptions, when does the standard and why does the standard prohibit you in terms of creating a DTL or a DTA? In terms of goodwill, circular effect, and for other differences which are technically permanent. And here only one case that it is technically permanent. So these are the exceptions where the standard says you are not going to recognize. Just remember the two exceptions out here and the one exceptions out here. So I guess your comfort zone should be at least around 8, 9, I guess. Koski tells me 10. That's brilliant indeed. Wow. Okay, so I hope my other friends also feeling very comfortable on the agenda. Now let's go to the block number 2. Now we're going to talk in terms of the block number 2, which is slightly confusing, slightly technical. So I'm going to make a base, and I know the right point when your mind is going to give away. We're going to give you a break at that time, not right now. So once your mind starts working, oh my God, what is this so technical indeed? Then I'm going to give you a break. Now, okay, and I think Shriram tells me 7.5 out of 10. That's still pretty good. Okay, I think Shriram, can you please make a note of the circular effect? Okay, the note on the circular effect, I guess I've already covered that in a practical illustration. If you've seen, I'll be sharing the PDF in any case to you. So that will be uploaded on the portal. You can see I've done that. This is my circular effect, which I've explained. So we're going to share that with you, no worry. Okay, so I'm now going to take you further on my second block of discussion. And on my second block of discussion, I need to consider on the second block a case of investments. Now, this is going to be a little tricky for you, so don't get worried. Slightly technical discussion, again based on certain inputs which you may or may not be aware of. But I think I need to give you some understanding before I take you to the block number 2 on investment. But let me first read. Let me first read the inputs which are given out here. I'm looking at the taxable temporary differences. However, for taxable temporary differences associated with, however, the taxable temporary differences associated with, it says if there are taxable temporary differences which are associated with investment in subsidiary, branches in associate, and interest in joint arrangements, a DTL shall be recognized in accordance with para 39. He says that if it is a case of investment in a subsidiary, in an associate, in a joint arrangement, he's talking of 3-4 kind of investments: investment in a subsidiary, investment in a branch, investment in an associate, or there is interest in a joint arrangements. A DTL is subject to something which he says we're going to talk in para 39. He says if you got an investment in these companies and your carrying amount and tax base is different, please apply the concept in para 39. We'll see what it says. Okay, let's have a look further. I'm now looking at the deductible temporary differences. I'm looking at now the deductible temporary differences. However, for deductible temporary differences associated with investment in subsidiary, branches, associate, interest in joint arrangement, a DTA shall be recognized in accordance with para 44. The language is same, but the reference to the para number is different. It says that if you're getting a DTL for the investment, please go to para 39. You don't need to remember the para. And if there is a DTA, it says please go to para number 44. But the question now comes, why would there be a difference in the carrying amount of the asset investment in terms of accounting and in terms of tax base? For this, we need to understand the accounting of investments given for a subsidiary, associate, joint arrangements based on Ind AS 110, Ind AS 28, and Ind AS 111. Oh my God. So is this block number 2, sir, you're trying to say is an interaction of the consolidated financial statement standards and Ind AS 12? Yes. My friend Viraj was asking me, how do you take care of the differences in terms of consolidation? I said, no worry, we're going to shortly come to that. So I think the time has come. Now we're looking in terms of that if you're making consolidated financial statements, then there could be a difference in the carrying amount of the investment. Now, I'm not going to explain you the concept of why a difference arises in a subsidiary or an associate or a JV. I think let's take one of them as a base. Let's consider associate as a base and explain the position to you. So let's do one thing. Let me just come to the concept of just an associate. So I'm again going out of the standard. And I'm just going to give you a flair of what, Ind AS 28 says. I'm taking you out of the standard to understand the block number 2, and I'm taking you to Ind AS 28. It basically deals with accounting for associates and JVs. It talks of accounting for investments and joint ventures. Now, very carefully, I'm not giving you a deeper knowledge, but I'm just giving you a basic knowledge to understand the concept of the Ind AS 28, only to the extent I require for this standard. Ind AS 28 says that when you account for investment in the consolidated financial statements, you need to apply what is called an equity method of accounting. I'll take an example to illustrate that, but the standard Ind AS 28 very clearly tells you that a company, while making a consolidated financial, because if you got an associate, let me tell you, an associate is a company where generally you've got 20% or more voting power. So if I make an investment in a company which is generally 20% or more than 20%, there can be exceptions, but that you're going to see in Ind AS 28. So if a company makes an investment in a company where you've got 20% or more voting power in a company, that company becomes my associate. So I'm required to make a consolidated financials in which when I prepare the balance sheet of the company, let's say on a T-shaped format, this investment in the balance sheet is supposed to appear using what we call equity method of accounting. The standard Ind AS 28 says that when you've got investment in associate, the investment in the consolidated financial statements will appear using what we call equity method of accounting. Now let's understand what is this equity method of accounting slightly so we can understand the logic of the block 2. Let's take an example with figures. Let's say there is a company A Limited which acquired an investment in B Limited. Let's say he acquired a 20% stake in the company at a cost of, let's say, 20 lakhs. Let's say he acquired a 20% stake in the company, let's say at 20 lakh. So initially, the investment will get recognized in the books of accounts at 20. Now, let's say the net assets of B Limited on this date, let's say the net assets of B Limited on this date is, let's say, to the extent of, let's consider, to the extent of, let's say, 90 lakhs. So let's consider the net assets of B Limited when A acquired a 20% stake in the company was 90 lakhs. So we can say the share of A Limited, the share of A Limited in 90 lakhs is 20%, that is 18 lakhs. So immediately you'll be able to identify that there was an excess paid, which is technically goodwill. The concept is same. So when the company A acquired a 20% stake in B at a cost of 20 lakhs, I said, okay, what was the net assets of B at the time? It was 90. I've got a 20% stake. So we can say 18 lakh is the stake. So we paid a premium, which is to the extent of 2 lakhs goodwill. The standard says, do one thing. On this date, reflect the investment at 20 lakhs and show in the inner column that this is including a goodwill of 2. That's it. I'm just giving you a very basic understanding of the equity method of accounting. The standard says that if you acquired a stake in the associate, do one thing, whatever is the value at which you acquired the investment, but just reflect in the inner column that, okay, this was the amount of goodwill which was paid at the time of acquisition. That's it. Now, what does the equity method say once we move ahead to the subsequent years? Now, watch this carefully. Let's say these are the two hands. Of course, these are the two hands. This is the net assets of associate. This is net assets of the associate, and this is my investment. The equity method says that if the net assets, which is also equity, of the associate goes up, you need to increase the value of the investment. The investment should always represent at the share in the net assets. So today, what is the value at investment is appearing? It is appearing at share in the net assets 18 plus the goodwill. At the time of initial recognition, the investment is appearing at what? It is appearing at share in the net assets 18 plus goodwill. Now, we will maintain that parity. If the net assets of the associate goes up, I will take 20% increase, 20% of that increase as a part of the investment. If the net assets or equity of the associate goes down, I'm going to take a decrease in the investment to the extent of 20% of the decrease. So which means that this value of investments will either increase or decrease depending upon the net asset position of the associate. By the application of the equity method of accounting, the value of the investment will keep changing. Because if the equity of the associate goes up, the investment goes up. The equity net assets goes down, the investment goes down. So from the accounting point of view, the carrying value of the investments will keep changing due to the change in the net assets of the company. But imagine the carrying amount is fluctuating, but what about the tax base? If you tell the government that if I sell the investment, what is the deduction you will give me to calculate the profit or loss on sale? Will they give you a deduction equal to the carrying amount? No. They will give you a deduction equal to the original cost of 20 lakhs itself. Which means that the carrying amount and the tax base in this particular case is going to be different. And this means it would lead to deferred tax consequences as well. You're going to get a deferred tax asset or liability depending the carrying amount is more or less, whatever. Right? I'll just quickly take a recap of this to you before we take this further. Right now, I am out of Ind AS 12. And I'm just giving you a picture of why the standards on consolidation, for example, Ind AS 28, would lead to a difference in the carrying value of the investment and the tax base of the investment. So I gave a simple example on Ind AS 28, where I said that a company gets a 20% or more stake in a company, it is your associate. Ind AS 28 tells me that if you get a significant influence over a company, which is 20% or more voting power, it becomes an associate. Please use an equity method of accounting for investments in balance sheet, consolidation. So from the consolidation point of view, the investment starts appearing at an equity method. So when you acquire the investment, you segregate the cost in two elements. What is the share in the net assets? And if you paid more goodwill, if you paid less, it's a capital reserve. You just need to disclose that figure in the inner column that there was a premium goodwill or there was a capital reserve. But your investments at that point of time appears at the cost itself initially. Initially, it appears at 20 lakhs with the bifurcation that this is the goodwill or this is the capital reserve. But periodically, what happens under equity method is that once the net assets equity of the associate moves up, let's say it moves up by 40 lakh, investment should increase by 20% of 40 lakh, 8 lakh. If the associate equity goes down, you need to bring down the value of investment, whatever is the decrease, into 20%, such that the investment will always stand equal to the share in the net assets plus the goodwill or minus the capital reserve, as the case may be. The investments will always appear at a fluctuating figure because the investment in the balance sheet is going to be an index, a reflection of the share in the net assets of the associate company. So which means the carrying amount is a fluctuating amount after initial recognition. The carrying amount of the investment is going to be a fluctuating figure post initial recognition, but the tax base, being a future deduction, is going to be the original cost, because income tax authorities will give you a deduction only equal to the original cost of the investment when you sell the investment. So the carrying amount and tax base will be different, resulting in a different tax asset or liability, as the case might be. I hope, friends, I am clear that why a carrying amount of the asset, investment in console and the tax base is going to differ. So this was a little out of the standard, but I think just a working inputs to understand the concept. Okay. And Rahul Karke, excellent knowledge. Thank you, Rahul. Namrata, so value of investment depends on the basis of the value of equity of the investee. Yes, absolutely correct. So we can say, yes, in terms of the equity method in this 28, we can undoubtedly say that, yes, we are reflecting the investment equal to the share in net assets at any given point of time, plus the amount of goodwill or minus the capital reserve. Wonderful. Now I think your mind must be a bit discharged as well. So it's a good time to give you a break now. And we're going to concentrate on the concept of that para number 39 and the para number 44. I'm going to give you a detail with logics and also tell you what you need to do from the examination point of view. So it's going to be a little heavy discussions after the break, but that's one of the crucial part, because step 4 and 5 is not going to take much time, except that I need to give you the prudence concept. So investments and prudence, these are the two concepts. Then we'll do a little bit practice, of course, with you as the time permits. So I think, Claire Koshki, wonderful indeed. So I think it's time to give you a small break, almost around 8:43, 8:44, so 10, 12 minutes. I see you back, friends, on this. So enjoy a break. I'm going to join you after the break. Welcome back, friends. So I guess Koshki, up to break was also heavy, but clearly understood. That's wonderful indeed. Okay, let's take the journey forward now. Given you a background in terms of why the investment in the consolidated financials and the tax base would vary, now we need to see in terms of what kind of assessment is required. So what I'm going to do, I'm going to first of all take you to the inputs of the conditions which are given in the para number 39 and in terms of para 44 for a DTL and a DTA respectively. And then I'm going to explain you the logic as well. So don't worry, we're going to understand the logics as well. But first, let me take you to the inputs which is given in the para number 39 and the para number 44. So I'm carrying a little extract of what the para number 39 tells me on the taxable temporary difference. Let's have a look. So let's just have a look at what is stated. Don't worry on the logic. Let's just read the language. It says an entity shall recognize a DTL for all taxable differences associated with investments in subsidiary, branch, associate, interest in joint arrangement, except to the extent both of the following conditions are met. So one thing which we need to clearly understand is that if there is a taxable temporary difference related to investment, I am supposed to recognize a DTL. As a basic principle, as a basic rule, you can say that if there is a taxable temporary differences related to investment, the standard says go ahead. But he says, except to the extent both conditions are met. If these two conditions are met, a DTL is not going to be created. So let me read what are the two conditions, but let me tell you, if you say that you don't create a DTL, you need to meet A and B both, which means if you meet A but don't meet B, DTL will be recognized. Get this clear? If you meet, let's say B, but you don't meet A, DTL will be recognized. So what is important is that if you meet A and B both, then the DTL is not recognized. So the only situation when a DTL will not be recognized is when you meet both conditions. One is met, another is not met, not sufficient. I'll create a DTL. So let's look at the two conditions given. It says the parent in terms of a subsidiary, investor in terms of an associate, joint venturer or joint operator in terms of joint arrangements is able to control the timing for the reversal of temporary difference. If the investor is able to control the timing of reversal, if the investor is able to control the timing of the reversal, that's one. If you meet this condition and B, I will not allow you to create a DTL. It is probable more than 50% chance that temporary differences will not reverse in the foreseeable future. What does this mean? That if they will not reverse, they're as good as permanent difference. It says it is probable that temporary differences will not reverse in the foreseeable future. आने वाले समय में मुझे लगता है ये differences reverse नहीं होंगे. So it's a permanent difference. So there are two conditions: that you control the reversal, and number two, it should be as good as a permanent difference. So if you say you control the reversal and it is probable that it is as good as a permanent difference, then the standard says don't recognize a DTL. Now you would say, sir, I don't understand except for the words. Can you take an example and illustrate this concept to us? Okay, I'll do that. Now for this particular purpose, I need to basically, give you some inputs in generic about a deferred tax asset and liability. So I'm going out of this para number 39 and I'm going to give you some knowledge which you need to generally understand about the implications of creating and reversing a deferred tax asset or a deferred tax liability. Now see this carefully. If you look at a DTL, we know a DTL could be recognized by way of P&L or OCI or equity or goodwill. But let's consider that your DTL is getting recognized because of a P&L difference. So what is the entry when you create a DTL? When you create a DTL, the entry is profit and loss gets a debit and DTL gets a credit. As a part of the tax expense, you will record the deferred tax liability. So this is like, you can say, a deferred tax expense that is basically enters the P&L, and a DTL, a liability gets created. So when you create a DTL, what happens? The profit goes down. So we need to understand the accounting implication is that when a company is creating a deferred tax liability, the creation means that the profits of the company will decrease because of creation of a DTL. Second, when you go for a reversal of a DTL, you're going to put a reversal entry, DTL will get a debit, and you're going to give a credit to the profit and loss. Same entry will be reversed. So when you create a DTL, it hits the profits of the company, but a reversal of a DTL, you can say, is going to impact in increasing profits. Am I a happy man creating a DTL? No. But am I a happy man if a reversal of a DTL takes place? Yes. A creation is reducing profits, but a reversal is making me happy. Because a reversal of a DTL will increase the profits in the year of reversal. Now, similarly, have a look at the concept of a DTA. Let's see that when you look at a DTA, its creation and reversal, what are the implications on the profits of the company? So if you look at the entry, when you create a deferred tax asset, you will put the entry DTA gets a debit. And in this particular case, you will give a profit and loss a credit. Let's assume that it got created through the profit and loss section of the company. So this is nothing but you can say it is a deferred tax income which is recorded in the income statement. Am I happy in terms of creating a DTA in the books of accounts? Yes, I'm very happy, because in this particular case, if you look at the implications on the profits, it increases my profits. Because the moment I'm going to create a DTA, it gives a credit to the income statement. I'm a happy man. But when you look at its reversal, the same position becomes bad for me. Because I'll put the entry profit and loss debit, the reverse entry, and a DTA gets a credit at that stage. And needless to mention that at that stage, the profit goes down. So this is one background you need to keep in mind, that a creation of a DTL is not enjoyed by the company. What does a company enjoy? So what does a company like? What is the moral of the story? What would a company like? A company likes two things out of all the four situations. It doesn't like a creation of a DTL. If you look at the impact in terms of profitability, the company would love to reverse a DTL. So they would love to reverse a DTL because it creates income. They would love to create a DTA because it creates an income. So this is the model of the story. I hope I'm very well understood in terms of the background. That what is the thought process of the industry? If I'm planning to enhance my profits, I would be a happy man if I am getting an opportunity of reversal. I am getting an opportunity to create a DTA. And if I can plan it, the best part. If I can plan the reversal of a DTL, I know the years when profits are going to be less, I'm going to plan it. And if I know that the years of profits where I'm getting losses, I'm going to plan a DTA. So there could be manipulative intents. The standard setters very carefully thought that, there are situations where the company could plan creating additional income when it comes to a reversal of DTL, when it is in their hands. Because technically speaking, if a DTL is getting created, it is technically never in your hands when the reversal will take place. But there are situations like investments, when the reversal will be completely in your hands. And when the reversal will be in your hands, you will try to take advantage and manipulate the situation. Let's see how. Let's see how. So this is one part. Now let's see the application of this knowledge on the manipulative intent of the company. Let's take the case of an associate company. Let's take the case of an associate company as an example to understand this bit. The same logic can be applied to a subsidiary. The same logic can be applied to other category of investment, but still, since I've given you associate, let's take that as a base. So let's say you acquired an investment in an associate. So I did the entry investment account debit, bank was given a credit. Let's say this was 20 lakhs. Same example. Considering that the share in the net assets is 18 lakhs and there is a goodwill to the extent of 2 lakhs. So I'm taking the same example that you made an investment in an associate at 20 lakhs. At that time, the net assets of the associate company was 90 lakhs. You got a 20% stake. So 18 lakh is the net assets and 2 lakh was the goodwill. So initially your accounting and the taxation book is reflecting investment 20. At initial recognition, the accounting and the taxation book is reflecting 20 lakhs itself. Now, what happens subsequently? Let's say the associate company earned a profit of, let's say, to the extent of 20 lakh rupees in post-acquisition period. After the acquisition, they earned a profit of 20 lakhs. So what is the logic I gave you? I said that if they earn a profits, the associate equity will increase by 20. But my investment will increase 20% of the 20, that is 4 lakh. So when the associate equity will move up, the investment will move up. So what I'll do, I'll pass an entry as per equity method. Investment will be given a debit and correspondingly a profit and loss will be given a credit. And that is 20 lakhs into 20%. So you put the entry 4 lakh. So the moment the equity net assets of the associate went up 20, investment has to go up, but not by 20. Share 20% of 20. So you took a 4 lakh increase in the value of investment. So what happens at this point of time? Earlier in accounts, the investment was appearing at 20 lakhs and in tax also 20. But now the same investment is appearing at 20 lakhs in the accounting books and it is appearing at 20 lakhs for the taxation books, resulting in a carrying amount greater, which means it's a taxable temporary differences resulting in a DTF. So at the end of the year, in the consolidated financials, the investment value due to equity method of application is more as compared to the tax base of the investment, resulting in a taxable difference and a DTL. So I would recognize a DTL on whatever 4 lakh into the tax rate. But now, the question arises, when will the reversal of this take place? Today, the associate company earned a profits and the equity net assets went up. I took the investment up. Tomorrow, when the associate company pays a dividend, the investment will fall down. The net assets will fall down, the investments will fall down, which means that this reversal, when will the reversal of this difference take place? The reversal of this difference is going to take place when you're going to distribute dividends. When you're going to distribute the dividends to the investors. So when you're going to distribute the dividends, let's assume that the entire 20 lakh of profits distributed to the shareholders. So once the dividends are distributed, I am going to basically reverse this entry. And after this reversal entry, both the books of accounts will stand at the same figure itself. Both the books will stand at the same figure itself. I hope you're getting the logic. Let me just consolidate those once again. I know it's a little bit heavier discussion because without having too much understanding on the equity method, it's a little difficult to understand. But I think I'm just giving you inputs to the extent we can appreciate in this term. So we need to understand one larger picture, that at initial recognition, the value of the investment in the accounting and the tax base will be same at 0 point of time at the initial recognition. But later on, what will happen when the associate company will start earning profits, their equity or the net assets will increase, and I will also increase the investment value to the extent of share in that increase. And if they are earning losses, it's the other way around, that the associate equity or net assets will go down, the investment should also go down to the extent of 20% the share in the loss. So the investment value in the accounting will change, but tax would remain the same. And if that be the case, it would lead to differences taxable in my example. But sometime or the other, this difference will reverse. When will it reverse? Today, when you earned a profit, the net assets went up, the investments went up. Tomorrow, when you declare and pay dividends, the net assets will go down and the investment value will go down. So when does a reversal take place? When the dividends are distributed by the investee company. So when the subsidiary, when the associate are going to declare and pay dividends, the reversal will take place at that stage. I guess, friends, I'm pretty clear so far at this stage, right? Okay, and Shriram, you said, so you took 20% on post-acquisition profits. The share of profits on post-acquisition will be accounted as a revenue profit affecting the P&L account. Then how would it increase the investment? Well, on one hand, you're increasing the investment in the balance sheet, and on the other hand, you're enhancing the profits in the consolidated income statement. These entries for equity method are applicable only for consolidation point of view, not for the standalone statements. So in the consolidated financials, one double effect is that you're increasing investment. The other effect is that correspondingly your income statement will increase. In the consolidated financials, which you're going to study later, you're going to see that the share of the associate and JV in the post-acquisition profits is a part of the consolidated income statement. So this P&L is basically the consolidated P&L account, right? Okay. So moral of the story. So I guess we've understood one thing, that when does a difference gets created? When they earn profits. When does the difference gets reversed? When dividends are declared and paid. Now get this one thing very clear. Now, let me just come back, and I think let's take you back on this agenda. I just want to come back to the case where we are now given the inputs in terms of para number 39. Let's have a very clear-cut look at this, because this is now going to give us the real concept. The parent investor, etc., is able to control the reversal of the temporary difference. You can control a reversal only when you control a dividend policy of the company. You can control the reversal. The reversal will take place when the dividends are declared. As an investor, can you dictate the investee company pay dividends? Now, I would say it depends upon the kind of relationship. As a parent company, you can always dictate a subsidiary. When you control a company, you can always dictate them that, boss, pay dividends now. I control you. You're the decision maker. But as an other investor, other than a parent company, if you've got a significant influence on the company, you cannot dictate them. So which means, if you look at the clause number A, the parent is able to control the reversal. I would say yes. See what it says. As a parent company controls the dividend policy of the subsidiary, it is able to control the timing of the reversal. The standard very clearly tells you as an explanation that, as a parent company, they are talking of only a parent company in the next para. It doesn't talk of any other investor. So I can say, as a parent company, this condition A will always be met. Mind the words carefully. I'm saying in terms of the parent company, this condition will always be met. So you don't need to look at the condition number A for a parent company. It is impliedly met. So I'm going to put across the question number 1. Do you control the dividend policy of the investee company? I'll say, okay, what is the relationship? Are you a parent? Then yes. If you're not a parent, the answer apparently is no. Now get this clear. So that means if you're looking at a subsidiary, this condition is met. But if you're looking at any other investment, this condition is not met. This condition is not met. Now hear me very carefully, friends. You will not be allowed to create a DTL unless you meet both. You will not be allowed to create a DTL unless you meet both. If you don't meet condition A, what is a good point whether you meet B or not? Are you getting the point? A condition आपका meet हो ही नहीं रहा. B कंडीशन आप मीट कर भी दोगे, जब तक दोनों कंडीशन मीट नहीं होंगे डीटीएल तो तभी क्रिएट नहीं होगा. वो कह रहे डीटीएल आप क्रिएट नहीं करोगे अगर दोनों कंडीशन मीट होंगे. इसका मतलब whether this gets met or it doesn't get met, it doesn't make a difference to me. So does this mean that for other investments a DTL should always technically get created? Yes. So but then why is the standard telling you it should only talk about subsidy now? Why is it talking of other investments? Well, there can be situations where even as a other investor, you could control a dividend policy. I don't deny that, but I don't want to get into those things from an examination point of view. So from the examination point of view, you can fairly go with the idea that if there are other kind of investments, condition A will always fail. And if condition A will fail, it doesn't make a difference to me whether condition number B is fit or fail. Because if you meet both conditions, DTL is not created. You meet one of them and you fail another of them, DTL has to be created. So if you get a question in the exams which is relating to investment in associate, investment in joint arrangements, go ahead and create a DTL. But if you get a question on a subsidiary, the first condition is met, which means what I need to do, I need to now assess the second condition. I hope you're getting the point. I know I'm speaking very technical, but if you want to get the concept, otherwise I can quickly, give you that this is to be done. That's the end of the story. You'll manage the question in the exam. But the idea is not that just manage the question in the exam. You need to get a larger knowledge as well. At the end of the day, we want you to become good qualified chartered accountants, industry experts. People know you for your knowledge. So in this particular case, once you look at a subsidy, the condition A is met, you need to assess condition B. So let's have a look at condition B. It is probable that temporary differences will not reverse. I need to now prove that it's a permanent difference. So which means what will I prove? Subsidy dividends नहीं देगी. अगर डिविडेंड नहीं देगी तो रिवर्स नहीं हो पाएगा. पेरेंट कंपनी इन्वेस्टमेंट बेचेगा नहीं. सो आई विल पुट अक्रॉस टू क्वेश्चंस टू द पेरेंट कंपनी. आप इन्वेस्टमेंट बेचोगे तभी तो रिवर्स होगा. वो कह रहे नहीं बेचूंगा. मैंने कहा आपकी सब्सिडी कंपनी डिविडेंड्स देगी, कह रहे नहीं देने दूंगा. इसका मतलब इट बिकम्स अ परमानेंट डिफरेंस. इफ ही प्लान्स नॉट टू सेल द इन्वेस्टमेंट, if he plans that the subsidy company is not going to pay dividends, the condition gets met and DTL will not be created. If the parent company is planning to sell the investments in the future, if the parent company knows that dividends will pay, the subsidy company will pay dividends in the future, I will say create a DTL. So the assessment will be based on the two conditions कि reversal होना चाहिए. वो तभी होगा जब डिविडेंड्स पे होंगे, वो तभी होगा जब आप इन्वेस्टमेंट बेचने की सोचोगे. सर संडे वाले दिन आपने हमको इतना टेक्निकल करा दिया. चलो एक बार कंसोलिडेट करते हैं. With a fresh mind, let me consolidate the picture of my discussion with you. Okay, in the meantime, questions. Namrata sir, then why you written associate? I think I would have already answered that question. Let me consolidate the picture once again to you. Let's do one thing. Let's clean this. Let's clean this out. Let's erase this out. And then, let's, I think, have a look at this once again with a fresh mind to get the concept. I want you to understand the logic, not cram. Not cram. So there is one background music. Rather, I would say there are two background music which you need to understand about investments. Two background music. You need to understand a bit of Ind AS 28 accounting, Ind AS 110 accounting, which you go to study in detail. But I've just given you one input on associate. I said you need to understand why the investment in accounting and the tax would vary. I gave you a simple application of equity method to appreciate that the value of investments in the books of accounts and in the tax books would vary due to application of equity method 1. Second, what you need to keep in mind is that a company likes a reversal of DTL. A company loves a creation of a DTL. A company knows that a reversal of a DTL creates income. A creation of a DTL creates income. They're very happy. So they can have manipulative intents. Now imagine. I'll now give you an example. So it says, except to the extent both the conditions are met. If you meet conditions A and B, you are not required. You cannot create a DTL. Now we know one thing. Subsidiary company earned a profit. Let's say associate or profits. Subsidiary company earned profits. The accounting value increases, but the tax base remains the same. Considering the same equity method kind of application. The subsidiary company earned profits, equity up, net assets up, investments value up. Same concept. The concept is same. So I said, okay, pay dividends. Once the dividends is paid, the accounting figure comes back to the same figure as tax. So what happens? When does a difference originate? When does a difference originate? When investee earns profits. When does a difference reverse? When they distribute profits. A parent company को पता है आज मेरे प्रॉफिट्स कम है 3 साल बाद आईपीओ आने वाला है कैसे बढ़ाऊं इनकम हियर मी केयरफुली पेरेंट कंपनी को पता है आज मेरी इनकम कम है अब 3 साल बाद आईपीओ प्लान कर रहा हूं कैसे बढ़ाऊं इनकम सब्सिडी अच्छी है वो प्रॉफिट्स अच्छा कमा रही है उसको बोलो अभी डिविडेंड्स नहीं देने का रुक जा आईपीओ आएगा फिर डिविडेंड्स देना सो द सब्सिडी कंपनी इज अर्निंग प्रॉफिट्स नेट एसेट्स इज इंक्रीजिंग इन्वेस्टमेंट वैल्यू इज इंक्रीजिंग 3 साल बाद आईपीओ आया मैंने सब्सिडी बोला डिविडेंड्स दे डीटीएल रिवर्स करूंगा अगर डीटीएल तब रिवर्स करूंगा सो व्हाट इज गोइंग टू हैपन द रिवर्सल ऑफ द डीटीएल विल क्रिएट अ ह्यूज इनकम इन माय बुक्स ऑफ अकाउंट्स हैव दे प्लान्ड फॉर इट हैज द इन्वेस्टर planned for the reversal yes when can he plan only when he controls the company as a normal investor that means other than a subsidiary you cannot dictate the investee company to pay dividends your associate will not listen to you your joint arrangements generally will not listen to you but a subsidiary has to listen to you because you control the dividend policy so you can always dictate a subsidiary company when to pay dividends and you can plan when to pay dividends because you know dividend distributions will lead to reversal of DTL and it will lead to reversal of DTL you will plan the reversal so what did they wanted to say that the parent company controls the timing of the reversal so how do you assess that you control the reversal if you control the distribution if you control the dividend policy you control the reversal I repeat if you control the dividend policy you control the reversal so we can say there is a parent company and there are other investors I will put across a question number 1 I will put across a question number 1 as a parent company do you control the dividend policy yes sir so do you control the reversal yes sir then I'll say as a other investor do you control the dividend policy no sir so do you control the reversal no sir condition A is always met for the parent because he controls a dividend policy condition number B will generally never be met for the other investors and when it says that if you want to you don't have to create a DTL you need to meet both A and B now A is not met how does it make a difference whether you get a yes or no for this condition because unless it is yes condition A yes condition B I will not create a DTL any other combination no yes I will create so in this particular case a DTL will be created so moral of the story from the examination point of view if you get investment in other than a subsidiary you can land up creating a DTL on the logical footing that the condition A is not met and condition B assessment technically not required. Because whether you pass or fail would not make a difference. Now, in terms of subsidy, if this is yes, I need to see whether it is yes or no, because if it is yes and yes, I will create a DTL. Sorry, I will not create a DTL. And if it is yes and no, then I will create a DTL. Don't worry, I'll give you notes on that. Don't worry, I'll give you notes on that in simplified version. So you need to make an assessment of the condition number 2. What is the condition number 2? It is probable that temporary differences will not reverse. अब आप कह रहे हो रिवर्स तो होगा ही नहीं, मैं कहूंगा रिवर्स नहीं होगा तो परमानेंट डिफरेंस है, क्योंकि रिवर्स नहीं होगा. अब रिवर्स कब नहीं होगा? रिवर्स तो तब होगा when dividends are paid. रिवर्स तब होगा if the investment is sold. आप मुझे प्रूव कर दो कि डिविडेंड डिस्ट्रीब्यूट नहीं होगा. आप मुझे प्रूव कर दो इन्वेस्टमेंट सेल नहीं होगी. If you can prove that there will be no sale of investment, there will be no dividend distributions, I'll say it's a permanent difference. Don't create a DTL. But आप कह रहे हो डिविडेंड्स तो पे होंगे, आप कह रहे हो इन्वेस्टमेंट तो हो सकता है भेज दे, then I'll create a DTL. Got the point? I hope I am pretty clear, friends, so far at this stage. Okay, I think Vikalp, you said, so if the reversal is long-term nature, if you look at the fact, it says it is probable difference, the temporary difference will not foresee in the foreseeable future. Now, what is a foreseeable future has not been defined in the standard. It is open to judgment. A foreseeable future could be, one could consider, let's say, around 2-3 years, or at least a minimum of one year, at least, I would say. It is open to subjective assessment, because this is something, what is foreseeable, what you can foresee. Generally, we can't foresee more than a year. So if I know that they're not going to, do things within a year, we can take that as a cutoff. And Navratri said, so other than dividend, is there any factors affecting the equity of the investee? Well, there could be, apart from profit, but I don't want to get into those details, because once we get to the consolidation standards, then you'll be able to understand it a little better. Once we do Ind AS 110 and 1128, you can come back to the Ind AS 12 interaction at that time, and you'll get more clarity of thought. But right now, I don't want to explain the reasons or differences other than profits at this stage for Ind AS 12 application. Okay. So moral of the story is now well understood for DTL. So let me get it clear. So next shall bata do karna kya. If you get a question in the exam, investment in subsidiary, tell the examiner that in case of subsidiary, the parent company always controls the dividend policy. Therefore, he controls the reversal of DTL. Tell him now there are two situations. If the subsidiary company is going to pay dividends or the parent company is going to sell the investments, I'll create a DTL. Situation number 2, if the parent company is not going to sell the investments, the subsidiary is not going to pay dividends, I will not create a DTL. Now, the second one is if there is an investment other than a subsidiary, I will say generally the conditions in para 39 will not be met. So I'm comfortable in terms of creating a DTL. So if it is other than subsidy, create. If it is subsidy, depends upon whether the subsidy will pay dividends, parent will sell the investments, कर दो create. ना dividend distributes होंगे, ना investment बेचेंगे, मत करो create. I think let's document this out to you. So let's make some notes out here, simplified version of our discussion. So let's put it in a simplified manner. So here I'm looking at now the block number 2, that is assessment. I'm looking at the block number 2, that is assessment. I know, friends, it's a very heavy standard and you'll have to make a revision as well. Maybe you can go through this video since it's going to be available on YouTube. You can, once again through your revision, take a little fast track movements, 1.5, 2x speed, what our generation does. So you can do that, of course, for your revision purposes. There's no harm. I fully agree with the the concepts of the new generation that you get a quick revision. The kind of facilities you've all been given in today's time is I sometimes feel envy, and I feel perhaps we had that kind of support systems where we had that kind of hand holdings, we would have done much better. But nevertheless, pain brings a lot of gain as well. All these things, what we are now explaining, these things are all based on a self-study approach. because we've been brought up in an environment, where we try to pick up things on our own. So I do definitely feel proud, but I think, that little help, a little help to people, in terms of a little hand holding gives them that extra edge. So people of the new generation are becoming more smarter because of the access. So do avail of these facilities and get the best maximum advantages of what you're getting. It's a very good initiative. Okay. So on the assessment, I'm looking at the block number 2. I'm looking at the block number 2. Now, in terms of the block number 2, when I'm looking at investment. I'm looking at investment, and I'm looking at investments from 2 points of view. I'm looking at investment in a subsidiary, and I'm looking at investment which is others. Others would mean associate, joint arrangements, whatever, other than subsidiary. So I'm now going to put across a question number 1. I'm going to put across a question number 1 to me. Does the investor control dividend policy? Does the investor control the dividend policy of investee? So I'm going to put across a question. Does the investor control the dividend policy of investee? Yes, always. Yes, always. This implies, when I say yes, always, this implies he controls reversal. He controls reversal of DTL. Very bad. If he controls the reversal of DTL, खतरे की घंटी, उसके हाथ में planning आ गई साहब. Very bad. So he controls the reversal of DTL. So let me put it out here. If he controls the reversal of DTL, very, very bad. He can do planning. This indicates he can do planning. रोको उस आदमी को, उसको DTL create मत करने दो. But अभी दूसरा condition भी है. In this case, it is no. Generally, I'm not saying always. Generally. So generally, in this case, we can say the answer is going to be no. So in this particular case, since the answer is no, we can say no further assessment required. No further assessment required. So in this particular case, no further assessment is required. And what I'm going to do, we will create a DTL. I'm talking of only a DTL. So I'm going to create a DTL in this particular case. No further assessments are required. Now, coming to the next question out here. So we will put a question number 2 now. This question number 2 will be for a subsidy now. So we will say, is it a permanent difference? Is it a permanent difference? I'm going to put across a question that is it a permanent difference? Can I say we need to assess? We need to assess. How will I assess? I will say, okay, are you going to sell investment? Or are you going to pay dividends? If the answer is yes, it's not permanent difference. If the answer is no, I will not sell investments, I will not pay dividends, it's as good as a permanent difference. Get this clear, that is it a permanent difference? So you need to see, आप investment बेचोगे, आप dividends pay करोगे, आप कह रहे हो जी करूंगा, तो permanent difference nahi hai. So if it is not a permanent difference, I will create a DTL. And if it is a permanent difference, we will not create a DTL. So you have to clearly tell the examiner what is the case in a subsidiary when a DTL is not created. This is a crux of the para number 39 with logics. Para number 39 with logics, that you need to see that do you control the reversal? Very bad if you control it. It's the first point where I should tell the company, I will not allow you to create a DTL. But if you prove it to me that you will not reverse it, it's a permanent difference, then it's okay. But if it is not a permanent difference, I'll create it. So the two focus questions need to be clear. Do you control? And is it a permanent difference or not? So if you control and it is a permanent difference, that's the only case where a DTL is not created. In all the cases, it's going to be created. I hope, friends, I am pretty clear so far at this stage. Let's now go to the Other one, this is with reference to DTL. I need to discuss DTA now. So this is with reference to the block 2 DTL. Now we'll go to the block 2 DTA. Okay, then after that we just have the concept of prudence. So let me just go back now to the para number 44. So here I've taken a little extract of the para number 44 as well, just like the para number 39, just to give you a feel in terms of what the para number 44 talks of. Now let's have a look at the para 44. It says an entity shall recognize a DTA for all taxable differences, deductible differences arising from investment in subsidy, blah, 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 to the extent and only to the extent it is probable that A and B are met. The language is very interesting. In para 39, he was telling me A और B meet हो गए, तो DTL मत बनाना. Para 44 में he is telling me A और B meet होंगे, तभी बनाना. So look at the contrast. In terms of DTA, you can create it to the extent and only to the extent A and B are met. If you meet both A plus B, you can create a DTA. Now, what is that A and B? Let's look at A. The temporary differences will reverse. That means they should not be permanent differences. It will reverse. It should not be a permanent differences. Now think about it. If you're creating a DTA and it is a permanent difference which will never reverse, मैं तो खुशी से पागल हो जाऊंगा. डीटीए क्रिएट करके इनकम बना ली, अब उसका रिवर्सल नहीं होगा तो पीएनएल में कभी प्रॉफिट सेट नहीं होंगे, मैं तो खुशी से पागल हो जाऊंगा. So the moment it is a permanent difference, I'm a happy man. So I need to prove कि नहीं नहीं ये difference तो reverse होगा. आज इनकम बुक्स में क्रिएट की because you got a DTA, tomorrow it will be reversed. So you need to prove it to me that number one, it's not a permanent difference, and you need to prove it to me that taxable profits will be available. What is this? COP, the concept of prudence, which is a generic condition. So the B condition is what? A generic condition that if you want to create a DTA, in any case, you always have to prove that taxable income will be available. It's a concept of prudence. So the only condition they put across is that number one, it's not a PD, and number two, you need to prove that the concept of prudence is met. So the only assessment required is that it is not a PD and the concept of prudence is met. Now, what is a prudence? We'll see. But I made it a point now, so I can definitely add this now to you. Let me just add it on the same inputs itself. So this was all the background. Yes, now I'm just going to add the notes out here on para number 44. So let's give you the inputs in terms of the assessment case of investments with reference to DTA. So we're looking at now the assessment for investments. Now I don't need to make a distinction in terms of subsidy, associate and all for a DTA. You just need to prove two conditions. So there are two conditions which you prove me. Condition number one, it's not a permanent difference. Condition number two, the COP concept of prudence is met. So if we say both conditions are met, if you say both conditions are met, if both the conditions are met, what do? The DTA is created. Create a DTA. If you're able to prove me that it's not a permanent difference and the prudence is met, create it. And if you say any one fails, any one of the condition fails, DTA not created. DTA is not created in this case. Simple and straight. That's the only kind of assessment which is required. So this is on the block number 2. I've covered the block 1, 2 exceptions for DTL, 1 exception for DTA. I've covered the block number 2, assessment for DTL, assessment for DTA, in terms of both the situations, 39 and 44. Rest of the DTL, no preconditions. Rest of the DTA, concept of prudence is there. So now we need to speak in terms of prudence. So let's take the journey forward to you in terms of prudence. So after prudence, we're not left with much journey. Step 4 and 5, of course, hardly much inputs to be given. but I wish I had a little more time. I've done some more questions with you because standard is quite deep. There's no dearth of taking you to much deeper levels of questions as well. But I've given you the larger concept very well. Once you do the illustrations connected with this in the study mat, trust me, you're going to come out very well on this. Okay, now let's go to the concept of prudence. I'm now going to take you to the concept of prudence. So as a part of my step number 3, we are now looking at the concept of prudence, where I'm going to give you a 3-step model. This is not a 3-step model given in the standard. It is something which I've created for ease of convenience, for the ease of understanding the concept of prudence. Now, I'm going to take one of the similar examples which is given in the study map itself, but I'm just going to take that example of my own. Now, the concept of prudence requires that future taxable income will arise. It is expected that future taxable income will arise. I should be able to prove that future taxable income will arise, then I can say, yes, the prudence is getting met. How would I make that assessment? Very simple. The standard says in terms of step number 1, do one thing. First of all, note down the reversal pattern of DTL. They say do one thing, note down the reversal pattern of DTL. Watch this example very carefully. Let's say sitting at the year end, I know the company has got, let's say, taxable temporary differences to the extent of, let's say, 1.5 lakhs. Let's say at the end of the year, the company has got taxable temporary differences, which is going to result in a DTL creation today. Is 1.5 lakhs. And the reversal will create income. As we've already said, a reversal of DTL creates income. So I said, okay, what is the expected reversal pattern? I'll tell the client that, okay, give me an expected reversal. How the reversal is expected to take place. Give me a little forecast on the expected reversal. He says, sir, after 1 year, after 2 years, and after 3 years, we are expecting almost equal reversal. So he tells me that this is the amount which is originated today, and the expected way in which reversal of this difference will take place is equal amounts each year. This expected reversal means what? That you will create income. Because of this reversal. A reversal of DTL will be creating income in the future. So I know that you're expected to create an income of 50,000 every year to come. Then I'll tell the client, do one thing. Now let's do one thing. Let's take the reversal pattern of DTA. I'll tell him that let's take a reversal pattern of the DTA. I tell him, okay, what is the amount of deductible differences at this stage? So he tells me that we've got a deductible differences of 2.2 lakhs. He says we've got deductible temporary differences which would lead to a DTA to the extent of 2.2. I say, boss, I need to prove that 2.2 lakhs will get earned. But I don't need to prove that this 2.2 will get earned in the next year itself. I need to see when will it reverse. So I said, okay, let's take it 2.1 for convenience. Let's take it as 2.1 for convenience to get a rounded off figure. So let's say it is 2.1 lakh. So I said, okay, give me a reversal pattern. He says, sir, I'm again expecting that 70,000 is the expected reversal pattern in the next 3 years to come. Which means that when I look at the reversal pattern of DTA, it will hit my PNL. So this indicates that I need this income each year. I need 70,000 in the first year, second year, and third year. This is what I will be able to earn because of DTL reversal. This is what I should earn if I want to create a DTA today. Get the point clear? Because when you're wanting to create a DTA today, you need to ensure, will you be able to earn what you want to reverse in that year? Will you be able to earn that much what you want to reverse in the second year, and so on? So I will say you are expected to earn 50, but you need to earn 70. Boss will restrict your DTA creation only 50. You are expected to earn 50 and you want 70. We're going to restrict your DTA creation to another 50. Here again, you are going to earn, expected to earn 50, but you need 70. I'll again restrict the DTA creation to 50. So I'll say, looking at the reversal pattern, I think you will be able to create only a deferred tax asset on 1.5. I say, since the expected patterns of reversal, the way the DTL will reverse will ensure how much income you will get. The way the DTL, the deductible differences, will reverse will indicate what you need. The reversal of DTL will tell you itni income aayegi. The reversal of DTA will tell you itni income chahiye. One-to-one comparison karo. Compare, this is what you are going to earn and this is what you need to earn. So you have to take and ensure, if you're not going to earn 70, I'll not allow you to create a DTA of 70. So that means the company will be having an unrecognized DTA of 0.6 lakh just because it doesn't have enough taxable differences. Let's say a company doesn't have taxable differences. You're going to tell them in step number 1 only, boss, you can't create a DTA? No. If you're falling short of step 1, or if you don't have taxable temporary differences, no issue. We take you to the step number 2. But you need to go to the step number 2 only after you've done step number 1. You will go to the step number 2 only after you're done with step number 1. You've already studied the reversal pattern of DTL and DTAs. You're feeling short, you go to step 2. Now ask the company, is there a reasonable certainty? This is assessment. Is there a reasonable certainty that you're going to earn the remaining 0.6 lakhs? Do you think you'll be able to earn 20,000 each year for the next 3 years? I'll ask them that, okay, 20,000 is a shortfall you're running. Do you think you're reasonably certain that you'll be able to earn at least 20 every year? They say, yes, sir, we are certain. I'll say, then you can create a DTA to the extent of 2.1 today. But this assessment will be done again and again. After the end of first year, I'll again start making an assessment. It's a reassessment continuous. I will not do this assessment one time at the time of creating a DTA. I'm going to do this assessment year by year. Now, let's say the company says, no, sir, we don't have a reasonable certainty in this case. I'll say, no worry, let's go to step number 3. Let's go to step number 3. And in this case, I will say, okay, can you give me some tax planning opportunities available? Can you give me some tax planning opportunities which are available with the help of which you can prove that you'll be able to create some kind of income? Which I feel from the examination point of view is going to be too much, but the examiner could give you information regarding tax planning. There is a question of the study material which tells you that a company with the tax planning opportunities will be able to earn a certain level of income. I take that into account for the creation of a DTA. So this is what my 3-step model is. Mainly the questions which comes in the exams on the concept of prudence is on step 1, where you need to create a reversal pattern sheet for a DTL indicating income which will arise, a reversal pattern of a DTA indicating the income you need, and you make a one-to-one comparison and you're able to come down to a conclusion that, okay, this is the amount which I can create today. If you're falling short, do a reasonable certainty assessment. If you're falling short, go to tax planning opportunities and make an assessment whether a DTA can be created or not. So this is on the prudence concept. Okay, so I think this is one bit. And now let's, I think, take you to the step 4 and 5. So my step 3, the most crucial step, as I said initially, when I started the standard, that step 2 and step 3 is the main step which you need to understand. Once the step 2 and 3 is understood, trust me, it becomes easy. Now, step number 4 and 5 is not a big deal. So we're going to quickly run you on the step number 4 and on the step number 5. So on the step number 4, I've already given you the inputs that you need to basically select a tax rate. You need to basically select what we call a tax rate. The standard is very clearly made a mention that this is what we call a substantially enacted. It is called a substantially enacted tax rate. It is called a substantially enacted tax rate. The other day, I was looking at the US gaps, and there is a standard relating to taxes and in US gap, and they very clearly say that we are not going to consider the substantially enacted tax rate. They've got very different concepts, so there are principal differences between the US gaps and the IFRS position. But anyway, we are concerned with the IFRS and the Ind AS. So they say that you need to consider what is substantially enacted. Now, what does the word substantially enacted is there? It is open to judgment, and there could be various permutation combinations. But in India, the position is very simple. Let's say the financial year is April and ending on March. So let's say this is the year 1st April 22 and ending 31st March 23. So what happens in the year 21-22, the budget comes, and now since the budget comes a little early, it comes almost mid of February. So what happens in India, earlier the budget used to come in March, and now the budget comes a little early. So what happens that this budget in February tells you the tax rate applicable for this year. So when I'm sitting on the balance sheet date, that is 31st March 22, I already know the tax rate for the next year. So technically what I'm going to do in this particular case, I am simply going to consider the rate applicable for the next year. So what I'm going to do in this particular case, year ended March 22, I will take the tax rate applicable for the year 22-23, that is called substantially enacted. Because this was a case of a finance bill, and I think by the time you're finalizing a balance sheet in a practical life, which is going to be at least 2-3 months later, so maybe in around June and July, you're finalizing the balance sheet on March 22. So you're already aware that what is the tax rate applicable, because the Finance Act must have been made. So in this particular case, you can say technically we need to consider a rate applicable for the next coming financial year. So this, of course, is given in the question. So we are not really worried on this part. So step number 4 is not a very crucial exercise, because the examiner would in any case give you that, okay, this is the tax rate. Now, coming finally to the step number 5. Step number 5, I think I'm just going to make a little refinement now. So when I look at the recognition of a deferred tax, how many places are there for recognizing a deferred tax now? Can you tell me there are how many places where a deferred tax gets recognized? Initially, I said 3, but today I made an amendment and I said 4. So when you're looking at the recognition of the deferred tax, it either gets recognized through P&L, or it gets recognized in OCI, or it gets recognized in SOKI, or it gets recognized through goodwill. But goodwill will be only when it is arising on business combination. It is arising on a business combination. Now, let's give you a few examples to understand where the difference will go to the P&L, when it will go to the OCI. So let's take a very few examples based on your existing knowledge of the standard. Let's say if the carrying amount of the asset and the tax base of the asset is different due to depreciation. Let's say if the carrying amount and the tax base of the asset is different due to depreciation. Depreciation goes in the P&L. So you are going to recognize the deferred tax in the P&L. Let's say if the carrying amount of the asset and the tax base is difference due to revaluation. Due to revaluation. We know the revaluation gain goes in the OCI. So the related deferred tax will also go in the OCI. So in this particular case, the revaluation gain goes in the OCI, related deferred tax will go in the OCI, which means that when you were doing Ind AS 16 and you were putting the entry that the asset is being revalued, PPE debit, this was the 100% gain. You are correspondingly going to recognize, you can say, a revaluation surplus and a DTL. Technically, in Ind AS 16, what are you going to do? When you revalue the asset, the carrying amount will be greater than the tax base, resulting in a taxable difference and a DTL. So you're going to split the gain between the two components in this case. You will say that whatever is the amount of deferred tax liability, segregate that. The balancing figure goes in the revaluation surplus. And if the difference in the tax base, let's say the difference in the carrying amount and the tax base is both due to, it is both due to depreciation as well as due to revaluation, you have to split. There is a wonderful illustration given in the study mat where we are given the elaboration of the concept that, if the carrying amount and the tax base is different due to both depreciations, due to depreciation will enter the P&L, due to revaluations, it is going to enter in the other comprehensive income. The places where you're going to consider SOKI is when there is correction of errors, as I gave you earlier, or there are changes in accounting policies. When a company, by virtue of Ind AS 8, this is typically by virtue of Ind AS 8, mainly you will see in terms of Ind AS 8, where a company makes a correction of errors. When the company makes a retrospective change in policy, they are parked in the SOKI. So related deferred tax will arise out there. You'll hardly see questions on that because in Ind AS 8, in most of the questions, the concept of deferred tax has been ignored. But practically, when we do the concept of a deferred tax, when a company makes a correction of errors related to the past, or when there are changes in the accounting policy, then the impact of deferred tax on these items are rooted in the OCI. So this is step number 5, that what is the place at which the deferred tax income or deferred tax expense needs to be recognized. When you recognize a DTL, it's a deferred tax expense. So do we take it in which section? When it's a DTA, you recognize a deferred tax income. And that's again, which section of the statements do we take? So this is, the end of our discussion, the 5-step model which I've given you. So the carrying amount, the tax base, the differences, taxable, deductible, the selection of the tax rate, and then finally deciding the place at which it is to be recorded. I trust that you've got the larger concept. I wish we had more time to cover some more practical illustrations on the application, but I wanted to give you the concept very deep. So that when you go to practice questions from the study material or from the RTPs or past examination questions, you are not facing any conceptual problems. But in any case, if you get any questions, friends, please feel free to put in the mail at the ICI, the mail. And so in that particular mail, I'll be happy to revert to your questions. But our journey for the sessions on Ind AS 12 comes to an end. So hopefully, of course, we might meet later, but I don't know when. The schedule is yet to be declared. So thank you very much. Let me see if you've got any questions, friends, so far. Okay, Koshki tells me all the concept is clear, sir. That's wonderful indeed. Super. That's great. So any questions coming from other friends as well? I think, yes, Namrata, you gave some good answers on that. Great. So that's really lovely, enjoyable as well. I'm very happy to see, the active participation with which, most of you giving answers. And that's really great. Okay, and thank you for such technical explanations. Thank you, Goshki. Namrata, can you please provide an email ID? I'm just forgetting the exact email ID, but I think it's there on the app. I think it's financial reporting, something. The nomenclature is financial reporting, but I don't remember it right away. But you'll see that on the app, or maybe you can just, search it on the website. You'll see that, and you'll be able to connect with that. Yes, I think Koshki sends me. It's It's FR-ICAI. Yes. Yes, it's FR-ICAI. I think maybe somebody can send the complete mail. It'll be good. I think Somebody will be able to connect with that. Right, friends. So I think that seems to be all good. So I take leave from you, friends. Enjoy your weekend and study hard. Thank you. Take care and bye bye. Thank you, Nidhi. Thank you so much. क्लोज कर सकती हैं। हाँ जी, आया जी, क्लास बंद कर सकते हैं।